The economy is running out of fuel.
The Fed is not looking to tip the market into a recession. I think that is the bad case outcome in this situation.
There is still more work to be done to ensure that we remain on a disinflationary trend back to 2%.
We've got this sort of European higher for longer theme.
We are still in an environment where the dollar is proving to be the safest haven.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Slowly and then all at once, we have a correction, at least in the NASDAQ. Good morning from New York for our audience worldwide. This is Bloomberg Surveillance. Tom and John and Lisa, Tom and John are both off on a cruise together. John decided to invite Tom over. I am joined, I am so lucky to say, with Manus Cranny, as well as Damian Sassower on this day. And honestly, I have to say, Manus, we have a correction, and it doesn't feel like one in the NASDAQ.
It doesn't, and now you're going to get a load of buy-side notes coming through your desk which say, this is your opportunity to rebalance your portfolio. Where do you want to go for defense? Pick up some Microsoft. Would you want some spice in your life? As the last guest said, you laughed at this, which was, let's go long of Amazon. I go, okay, grand, I'll have a bit of Amazon.
Well, Manus, how much more bullish can we get? I think the street has like 65 buy ratings on Amazon and like 1 hold rating. I mean, there's no sells. I mean, you know, Intel and Amazon, it's amazing what a little bit of sentiment can do for the market.
All I can say is I was looking at some of the flows, and actually there was the biggest inflow into tech stocks over the past week, going back 8 weeks. So speaking of buy the dip, that's exactly the feel that we have underpinning everything. But some people are wondering, maybe this excuse to sell anything, yes, it's geopolitics, but yes, it's also the yield space and how much it's been fluctuating around.
Well, the yield space, just focus on that. We've had this sort of, when we came in here on Monday morning, we'd ratcheted by 50 basis points. We've given a little bit of that back this week. But look at the shorts on treasuries, and they are building again. If you look at the open interest on treasuries, they are rebuilding their short positions again. Then you're going to get a load of notes telling you to buy bonds in duration at 5%.
Well, I mean, rate differentials that's the name of the game for me. I mean, that's been the driver of currency performance pretty much all year, especially in emerging markets. And we've got a lot of central bank meetings coming up next week, not just in developed markets, as we all know, with the BOJ, England, and Fed. I mean, we've got Malaysia, we've got Norway, we've got a lot of other central banks. And in emerging markets specifically, they've been in front of the Fed in terms of cutting rates in the face of it all at risk to their currencies.
I love having you on, Damian. It's always, the other banks matter more. And let me tell you, they've been ahead of the developed market banks. That's what you've been saying. We are expecting the Fed meeting next week. And today, we do get that PCE figure, which we would be leading off with if it weren't for everything else happening in the world. How much is that going to give a green light to the Fed to never hike again if you get any kind of disinflation like we're expecting?
I really can't answer what the Fed's thinking, but what I do think is Yellen's comments yesterday speak volumes.
Thanks,
about, quite frankly, what she's talking her book, the fact that she's trying to say that this move in the long end has nothing to do with supply, nothing to do with fiscal deficits, everything to do with a stronger U.S. economy, which to me is just, I don't want to say nonsense, but it's talking her book.
Well, yeah, but it is that she used to have the job running the Fed, where deficits were something that was on the front of her sheet, to actually a political role, which is deficits don't matter. Just in a conversation with Janet Henry, who's at HSBC, and she actually, interestingly, chief economist at HSBC, when I said, do deficits matter? She said, actually, I agree with Treasury Secretary. At the moment, it is about the absolute conviction of the U.S. growth story. I think there's a middle ground, isn't there, in this story?
Well, you said that you don't buy it. I think a lot of people would agree with you, and I read these
comments.
I'm
with him, by the way.
Okay,
just a term premium story. It's a term premium story.
To set the record straight. There is this question, though. Yes, she is talking her book, and she's also coming out and saying that yields could come back down, and that there is nothing structurally that has changed to have yields be higher in the post-pandemic period. Everyone who I talk to says that's not true, and it actually ties back to that tech story we were talking about earlier, in addition to a whole host of shifts with respect to spending. So why don't you buy it? Why do you think she's talking her book? Does it matter that she's coming out and even talking her book at a time where everyone basically shrugs it off and says, we're still watching the
Who were the three stable buyers of treasuries over the better part of the last decade? It's been the Fed, who's no longer there. It's been banks, who are obviously of last resort, and it's been offshore buying. And offshore buying has not been there. We know this. Treasury buying from Asia specifically just hasn't been a supportive factor. So you're seeing these auctions tail. And I think that, quite frankly, it's a supply and demand issue. There's a clearing price for everything. And it looks like the clearing price of the 10-year or the 30-year, the market's still looking for it.
Well, we're still trying to grapple with that. There is a very good note from Paul Donovan. I know he appears with you and Tom and John very often, and he talks about the hedonism of the U.S. consumer. I think this is a great, great line. When we go to write 21st century history, it's going to be written as this. The opening sentence should be in bold. Never go short the hedonism, or hedonism if you're American, the hedonism of the U.S. consumer. And therein lies the point. Therein lies the point. Revenge spending, revenge tourism. The consumer is alive and well and spending their savings here.
Proudly hedonistic and, moving forward one day at a time. What we are seeing in markets is a bit of a lift, certainly in equities. And this is a bit of a reprieve after yesterday's sell-off that did put the NASDAQ firmly in a correction, down 10% from its peak earlier this summer. We could see the S&P futures still, though, under that key 4,200 mark. Euro basically going nowhere, but a little bit of stability after a press conference decidedly boring, which is exactly what Christine Lagarde wanted yesterday. 10-year yields marginally higher, but massive decline yesterday on the heels of, I don't know what, a very strong GDP. We could talk about how there really is not a lot of logic to some of these moves in crude prices, climbing just a bit as fears of re-escalation do continue, where there were those strikes on some Syrian areas by the U.S. They were retaliatory. We can get into that later. What I am watching for today is at 8:30 a.m. September personal income, personal spending, and core PCE. To Manas's point, Damien, don't get in between an American and a cash register. Are we going to see that today?
3.4%, is that the number we're looking for?
Something like that.
I mean, that seems a far cry from the 2% target the Fed's really looking for, right? So there's still some work to do. There's some wood to chop. And I mean, if it's 3.4, it's 3.3, it's 3.5, it's 3.4.5. I don't think it really matters. It's just another data point. I think markets are going to be more focused on next week, what the Fed actually does. And so, yeah, I think that's really going to be the calculus here.
Meanwhile, we do have this meeting. President Biden is meeting with Chinese Foreign Minister Wang Yi when he visits the White House later today. We'll talk to you a lot more about this, Damien. But Manas, from your perspective, how important is it to understand the read-through when it comes to the Middle East and China's position on that?
Well, look, China and Russia, the Iranians are here in New York this week, and already there has been differences within the UN. In other words, China, Russia, and Iran taking down some of the measures that were being put forward on the right of Israel to defend itself. So that relationship is incredibly important.
And meanwhile, at 9:30 a.m., we do have National Economic Council Director Lael Brainard speaking at the U.S. recovery, on the U.S. recovery, I should say, at the Peterson Institute, probably going to echo what we heard from Janet Yellen. Joining us now to really talk about whether maybe they buy the idea of the Treasury yield lift coming solely from the strength of the U.S. consumer is Steve Auth, Equities Chief Investment Officer at Federated Hermes. And I'm wondering, from your perspective, just taking a step back, is this a buying opportunity after a sell-off, after a correction in tech stocks, even though there still are all these headwinds?
Well, yeah, we think it is a buying opportunity for the market broadly, Lisa. Tech stocks had a nice little correction. They're still down. If you look at the top 100 NASDAQ stocks, they're down 30% actually off the market highs back in 19. People forget that we're still really in a bear market overall. We haven't really re-pierced those highs yet broadly. And, earnings are up 30%. So in a way, they're kind of valuation-wise have corrected 50%. We're still underweight, though, tech stocks. We're overweight stocks, 50% of max now. We added to stocks again this week on Wednesday on that big down day. And we added actually to large cap growth. So you could say tech stocks. We're still underweight there, but we're legging in. That's where we've felt the most vulnerability in the market has been. It's why we've been underweight. And I don't know, it's hard to call a bottom, but we're legging into the market and particularly to large cap growth here.
So, Steve, good morning. The question is, when you add and you're at maximum equity allocation at the moment, and you add it on that day,
not at maximum. We're at 50% of maximum.
50%, excuse me. When you added, how did you decide to differentiate on Wednesday? Did you differentiate between broad growth and the top seven, as it were, tech stocks?
We're being very selective. I put out a piece a couple of weeks ago about the return of the stock picker. I know people have been saying that, but we look sector by sector, and there are winners and losers emerging in this new world we've moved into. With let's say a 5% Treasury, union wage demands, et cetera. So you got to look for your winners and losers. In tech land, we actually like some of the more value type stocks in tech, like IBM and Intel. We own both of those. They reported good trends actually last night. Amongst the Magnificent Seven, we like a Google. But we like stocks across the markets. I mean, we like FedEx here. The transports in general look good to us. Some of the bank stocks are just completely washed out. So I don't know. It's hard to call bottom. I put out a piece last night called, Darkest Before the Dawn. Though it's very dark in the middle of the night. And you never really know if you're in the middle of the night or you're just before the dawn. But what people forget is that things don't have to get better for the markets to go up after they're sold off this hard. They just have to get...
But it doesn't feel that hard. To Lisa's point at the start of the show, I mean, you correct us. You're there. You've got skin in the game. It doesn't feel as if it was the most aggressive sell-off. Yes, a 10% correction, but normally you feel something a little bit more brutal to go through. It doesn't feel like that. So what is it?
Right. So the issue there is that the market commentary is all about the rally off the lows back last October. We're still in a bear market. The market's still down almost now 15% off the highs back in 19. Nominal GDP in that period has gone up another 50% by 2024. So over those 5 years, earnings in 19 on the S&P were $163. We've got 150 penciled in for next year, which is the high on the street, and people think we're crazy. But stocks eat nominal earnings. And yes, there's a digestion period, different winners and losers, as we said earlier, but we will get through this. And when we get through, we're going to be looking at an economy that's substantially larger in nominal terms, and that will translate through to earnings. And it's already doing so. The earnings season this quarter was the first up quarter in 4. We've really bottomed out. We'll see, where we end the earnings season next week, pretty much. But we're looking for earnings this year to end up at 230. The market's at 222 at the moment, but I think we're going to have a good fourth quarter given the strength. And one thing about the consumer, I heard you guys talk about that. You got it. It's not the consumer; it's the consumers. The consumption and income in the economy is jobs times wage growth. We've had almost 2 million jobs created in the last year, and wage growth nominally has been quite substantial. So when you add that together and add together the fact that the household sector net is a lender to the economy, right? I mean, there a lot of especially the aging demographic is making money off of these higher rates. And so, there's spending going on. There's winners and losers within the consumer, sure. Yeah.
Steve, you ever heard of the phrase defense wins championships? My question, the reason I ask that is we're in a period of high inflation, rising interest rate volatility, and yet consumer staples and utilities, traditionally low beta defensive sectors, are actually leading the S&P lower. If I wanted to take a defensive position on equities right now, how would you suggest I go about doing that?
Well, one, we like the staples here. Look at that Coke earnings report this week, right? I mean, there's an example of stocks eating nominal earnings. So, they're way oversold. We like that space here right now. One reason people like some of these large cap tech stocks is they've become defense just because these earnings and cash flow models they have are spectacular. They've got giant moats around them. And they've got another leg of growth ahead. We're still underweight there, but I think that's defensive. Cash is defensive, although we've finally taken cash. Tom's not here for me to announce this, Lisa, but we've taken cash down to neutral for the first time. We just did that this week in 18 months.
Canceling.
We've been overweight there.
Canceling Tom's fund. Yeah, I can see that. I'll have to pass that along to him that Steve Auth is pulling out of the triple leverage all cash fund for the first time. Steve Auth, thank you so much. We really appreciate you taking the time of Federated Hermes. And we have seen this, actually. People are pulling out of cash, Damien, and it's just starting to lag a little bit more into risk because buy the dip.
Well, they're not buying emerging markets, so maybe they are going to buy this dip in equities. We'll see.
Always selling something.
Exactly.
Right? Always selling.
Coming up at 7 a.m., Sarah Hunt of Alpine Saxon Woods, who maybe can give some love to the emerging market space just for Damien.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
There are no active efforts right now to evacuate Americans from the region, other than what we're doing in Israel, providing charter flights. There's no active efforts. And we're not parking ships off the coast and getting ready to send Marines in to get people out of, you pick the place over there. That's not happening right now.
That was John Kirby, U.S. National Security Council spokesman, who's going to speak again later today alongside Lael Brainard, as well as the spokeswoman for the Biden administration, I believe at 1 p.m., as they give the latest state of play on what's going on overseas, how the U.S. is evolving the situation with respect to troops and just generally the negotiations with Israel. Right now in markets, you can see a little bit of a lift. You can also see oil prices getting a little bit of a lift right now, as we do get a sense that maybe it's not clear that we can de-escalate this as much as we previously thought. Tom and John are both off today. I am very lucky to be alongside Manus Cranny and Damian Sassower. And I have to say, Manus, that one thing that's nerve-wracking to me are some of the strikes that are happening outside of the Israel-Gaza sort of theater of war, that you saw U.S. strikes in Syria, Iran-targeted areas, or at least Iran-backed areas in Syria, in retaliation. And this seems to be some sort of escalation.
Well, this is a very clear message from Blinken. And if you look back and you listen to what Blinken said yesterday at the UN, it was warning the people, the members, the voting members and the non-voting members of the UN, be on watch, message to Iran at whatever level. If you escalate this, there will be a repercussion. And Iran has escalated the war of words, and that they have said that the US won't be spared if the Israel-Hamas war spreads. And that's from the foreign minister. What exactly that means, is for anybody out there to extrapolate on.
I'm glad that you brought that up. I was reading the same thing. In the war of words, trying to understand it is one of the most difficult things. Kim Wallace is going to help us do that, which is really my main goal, is to understand what to take seriously and what not to. He's head of Washington policy research at 22V Research. And Kim, I want to start there. What do you make of the strikes that the U.S. called retaliatory in Syria?
There are a lot of points about that, Lisa, and good morning. The first I would say is there's no monolithic power in the Middle East, and certainly Iran is one of the many state actors there. But there are a lot of different militias and groups that operate at their behest and sometimes at odds with them. And so it's very difficult for any one spokesperson to speak for all of the elements in the region. From the U.S. side, certainly, the message of containment has been very strong. The presence of the Eisenhower and the Ford carrier battle groups sends a very clear message. I perceive that there are many more stakeholders interested in containment right now than spreading this conflict, largely for economic reasons.
It is a fine line for everybody to walk. Macron has been there, Biden has been there. There has been a troop of European leaders visiting Israel over the past 10 days. Is that why it feels like we're in some kind of a pause? It feels as if an all-out ground assault, and nobody knows, may not be as huge as originally planned by the Israelis. What do you make of this quasi-pause and quasi, I suppose, not cessation, but just de-escalation momentum?
Well, I think at first, in reaction to what happened our morning time, October 7th, very strong words coming from Israel, understandably. And since that time, calculations of what it would mean to have an all-out assault in Gaza and whether or not a regional conflict could be contained if there were an all-out assault in Gaza, and the costs to Israel and allies of an operation like that, given what Gaza is on the ground and beneath the ground, has sobered a lot of military planners, especially in the U.S. and I think increasingly in Israel.
Kim, the U.S. and Europe, as Manus rightly points out, have shown solidarity with Israel. But I want to talk about some of those countries, the Brazils, the Colombias. I mean, the United Nations itself. I mean, it seems like Israel's ability to interact with some of those players is deteriorating by the minute. I wonder if you have any thoughts there. And more importantly for me, being here in the U.S., what do you think the position on U.S. Republicans and U.S. Democrats are with Israel?
I mean, that's a lot packed in. I'll try to address them a bit at a time. Well, we've seen an effort, what I call reglobalization. I'm certainly in the camp that doesn't see much decoupling in the world. I see a lot of interaction in the world, and those relationships are changing. It goes back to a speech that NSC Director Sullivan made last June about the U.S. doesn't necessarily always have to have allies as partners, or put the other way, that our partners aren't always going to be our steadfast allies. That's happening around the world, and what some people call the global South are beginning to flex their muscle geopolitically. I don't see anything unusual about this. In Israel's case in particular, there's a question both internationally of the stature of the government under Netanyahu, and there's a question of his stature at home. Both of those complicate war planning and war execution. It's a stew. It's not an easy one to figure.
Well, Kim, I mean, you rightly point out the American war machine is back up and running. I think U.S. defense spending rose at the fastest pace since 2019. Talk to us about this $106 billion proposal from President Biden to fund Israel, Ukraine, all of that stuff. Do you think with Mike Johnson now as Speaker of the House that stands a chance of getting passed?
I think it stands a chance. I think it will pass. The question is in what form and when. Whether we have 2 or 3 separate supplemental bills to fund wars in Ukraine and Israel, and the timing of it. There's certainly momentum in the Senate. The Senate Appropriations Committee is scheduled to mark up the war supplemental funding request on Tuesday next week. The most surprising aspect to me of the request from the president, the $106 billion, is nearly $55 billion dedicated to defense industrial base investments over a long period of time. That conversation has been overlooked, understandably, because of the hostilities in the regions, but it's probably the one to pay more attention to over long term, both in terms of how the U.S. is able to enhance its productive capacity to fight multi-front wars. We've demonstrated, well, the U.S. has seen that its ability to do that has been dented, both by Ukraine and Israel, which are going to cause multi-year replenishments that had not been planned by the Pentagon 2.5 years ago. That's interesting information. And as attached to that is the inability of the U.S. defense industrial base to respond quickly. Those are lingering, I think, from an investment standpoint, lingering points to make out in this supplemental request.
Kim, how surprised are you that we haven't heard more about Senate Republicans coming in and sort of lifting their influence a little bit more when it comes to House Republicans?
It's a good question, Lisa, and I think part of the problem is it's likely that Senate Republicans don't have a lot of influence in the House right now. That old relationship, if it's tattered, maybe, but it unlikely exists. The power coming out of the House of Representatives from the Republican conference comes from the hard right, the Matt Gaetz and the Chip Roy wing. And as Gaetz has proclaimed, they feel they are in the ascendancy. We'll find out very soon. We'll find out in the fourth quarter how new Speaker Johnson manages the factions of his party, what it was he promised the moderates to get their support for him, and how that plays out in both the supplemental in the next few weeks, but more importantly, the expiration of the continuing resolution that's now funding government that expires on November 17.
Kim Wallace of 22V Research, thank you so much for taking the time. And I have to say, David, we didn't even talk about the deficit.
No, we didn't. Well, that's what I was saying, right? $106 billion on top of the CHIPS Act, the Inflation Reduction Act, all that stuff. I mean, can we really afford to spend that money? I hope so. But, what's that mean for U.S. yields?
The message to the world from this White House is that, yes, you can afford to spend. You will spend. You will support. You will support Ukraine. You will support Israel. You will support the pushback against Taiwan. So this is as much about a global message from this White House as anything else.
At the same time, there does seem to be at least a bit of a thawing in ties between the U.S. and China in terms of a conversation, and how much is all of the geopolitics and all of the uncertainty fueling into this need to at least quell one of the potential trouble spots. We'll talk about that coming up. We also are going to be talking about the inflation data coming out later this morning in about 2 hours. We are going to be joined by Rudabila Faruqi of High Frequency Economics. Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, Lisa Abramowicz. Tom and John are both off today. I am very lucky to have Manus Cranny and Damian Sassower. Manus giving me a lesson on the different iterations of grand and whether it means good or bad. Right now in markets, we can see a little bit of trying to, I guess, climb out of a grand sell-off that we saw. Just the correction that we saw in the NASDAQ yesterday, a little bit of a reprieve. S&P futures up about 0.5%. You're going nowhere. I mean, honestly, to me, Damian, the story yesterday out of the ECB was just that she made no news, Christine Lagarde. There was nothing really shocking, and that was 100% a win for her.
Well, I mean, when Manus says grand, I just think about Evergrande and the workout that's going on in China property markets, or Kogart. I mean, you have to go there, right? I mean, the property...
He just gets it straight back to EM.
Always.
I have to talk my book. Come on, no, I'm not going to talk about... Okay, I'll talk about China. So listen, this is the problem with China right now. We do have a meeting going on, Finance Minister, President Biden, but my fear here is no one's talking about what's going on in the South China Sea. No one's talking about the Philippine Coast Guard, how boats are getting pulled over, how U.S. destroyers are basically coming very close contact with Chinese boats out there. And so this all happens, and people think that the relationship between China and the U.S. is improving. I don't know how much it's improving, quite honestly.
Hold that thought. We're going to get there in 1 second. Let's get to under surveillance, because that is part of what we're going to be discussing, and I'm glad that you brought that up. Under surveillance this morning, let's start with Amazon rising in pre-market trading after reporting sales from its online store, ads and merchant services topping estimates, while third quarter revenue at its cloud computing unit fell just short of projections. Didn't seem to matter, at least when the share response. The CEO, Andy Jassy, said demand for generative AI is likely to boost the unit well into the future. And Manus, this was what I was looking for, some sort of discussion around how the new technology and the cloud computing footprint go hand in hand, because at some point you can use your customer base to then accelerate some of your technological rollout and get more clout. I just thought it was interesting that even though they missed on cloud sales, nobody seemed to care.
No, but then again, if they had reported that number just a couple of days ago, if you take yourself back to the eye of the sell-off storm in tech, maybe the repercussions might have been a little bit more brutal. One of the best lines, and folly of me not to know which analyst, it was enough to keep the goblins open. There you go, in terms of the cloud.
Well, for me with Amazon,
it was up 12%, so it wasn't exactly torturous.
I was pleased to see that operating income improved, and it means that those job losses actually counted for something earlier in the year. So, it looks like the numbers are pretty good, and it's amazing how sentiment shifted since it.
And the idea of cost cutting definitely raising a question of exactly where we are in the economic cycle. But this is a story that you're talking about, Damian. President Biden set to meet with Chinese Foreign Minister Wang Yi at the White House today. This is theoretically a move that could pave the way for a meeting between President Xi Jinping and President Biden next month. Biden has hoped to meet with Xi at an Asian-Pacific summit in San Francisco. As relations between the two nations improved from a low point earlier this year, Chinese officials haven't confirmed this. But at the same time, Damian, have relations improved? And that was the question that you were just raising.
Yeah, no, and we also have this National Financial Work Conference coming up at the beginning of next week, which is a really key meeting in China, in Beijing, because what we're expecting to see out of that is perhaps some color as to how they're going to handle the debt problem with the municipalities, with the local government finance vehicles. Are they going to issue more special bonds in order to sort of, bail them out of the crisis? Because this is extended from the property market into the financial sector. I'm talking about, the credit issues. So, I mean, basically what we're talking about is a credit crisis in China, and we need to do something about it in order to get the economy back up and running.
It does strike me, though, Manus, that just the idea of having a discussion is such a big win compared to the tit-for-tat and lack of communication over the past couple of months that we've been talking about. It seems like the market, at least, is reading it that way on the margins. But I take Damian's point. I mean, what are you hearing from people about this kind of softening?
Well, if China carries through with its stimulus policies, that's good for everybody at a global level. But what's more interesting, I think in conjunction with that, it's about the flow of money. The money has already not left totally from China, but there has been a significant outflow and a significant disinvestment or deinvestment, whichever word you prefer to use, from China, from equities, from bonds. And that FDI story is getting harder and harder to sell.
I don't think we can ignore the fact, rest in peace, Li Ka-shing passed away overnight. And, a reformist, Hu Jintao protege, kind of
he created
marginalized.
The Li Ka-shing index.
Yeah, right.
He was the vanguard of high-frequency data.
Rail, electricity, and I think it was bank lending, I think, are the three big components of that index. But, what's interesting is, look, I mean, he was marginalized under President Xi in the last few years, and it's just going to be. It's just it's just indicative of what's going on in that market and how under control and how it's kind of no longer as free as it once was, and how property rights have been called into question. So it speaks to all these topics, Manus, you're speaking.
We have to move on to our next story about the great economist, the one and only. She stays out too late, but she does get it done when it comes financially. I'm sorry, I'm cringing myself. Taylor Swift joining the Billionaires Club.
I love
the
this.
Eras Tour, propelling the pop star's net worth past $1 billion. This according to a new Bloomberg analysis out today. Swift is one of the few entertainers to reach that status based on music and performing alone. The singer's 53 U.S. concerts this year, also adding over $4 billion to the country's GDP. She also made it into the Beige Book in the Philly Fed Beige Book. But Manis, to me, the economic read-through, the sort of notes from companies that have some association with her and the pop that they get just highlights how much economic heft this person has.
Some of the countries that she visited, I mean, in the economic releases, it wasn't just in the United States of America. It was, I think, in part in Asia as well, in terms of inflation, in terms of spend. I mean, this woman gives girl power from the Spice Girls, from my era, a whole new meaning. You see, I got it back to the 1990s, just in case.
Have you been watching the Beckham? Have you been watching Beckham on Netflix? It's pretty awesome. But just going back to Taylor Swift, 53 concerts in the U.S. You're right, generated $4.3 billion in GDP. 4.3 billion. It's more than most small emerging market countries, by the way. I'm just saying. But she still has 89 more shows to go globally. Think about that.
Just the changes that she does. How many clothing changes does she do each show? Something more than like 100. It's worthy of quite a bit of money. Here joining us on Taylor Economics is Rabila Faruqi, Chief U.S. Economist at High Frequency Economics. And we talk about Taylor Swift, and people laugh and admire her economic heft. But it plays into this idea of how long can the inflationary boom, how long can the discretionary spending continue? How much are you looking to the PCE report that we get in about 2 hours' time?
Good morning. Yes, it's very important. That's exactly what we're looking at, the trajectory of the consumer and, what is sustainable, what is not. We don't think the 4%, growth rate that we saw in consumption in the third quarter is sustainable. We are going to see a slowdown, in terms of a payback, but it's just that component that, core services, X housing, this discretionary spending, this, the travel. If you look at the TSA numbers, they are not collapsing. If you look at open table reservations, they are not collapsing. Our base case still remains that, there will be the effects of, the policy tightening that are going to make it through, more widely through the economy. But it's just that we don't have any indication of a collapse, of imminent collapse. And it has to do largely with a very strong labor market. The labor market is adjusting, but it is still, very tight. It's very strong. And it's supporting incomes and it's supporting demand. And that is something that the Fed is worried about in terms of, acceleration in growth. That is an upside risk to inflation.
Well, we're seeing pay deals in the auto sector at around 25%. That is just one example in the private sector where we're seeing wages rise. To what extent is the U.S. consumers, as I've been corrected before, relying on their savings, dipping into those to sustain the momentum? I had HSBC with me earlier, and they said, listen, the U.S. consumers will sort of go right to the end of the road before they'll pull the brake. They'll put it on credit cards, they'll dip into savings. How important is that savings spend in sustaining this consumer momentum?
The savings portion of it, especially the excess savings portion of it, is very important. But, if you look at, checking deposits, if you look at the trend in M2, these things are still very elevated relative to the trend prior to the pandemic. So yes, but the consumer is dipping into savings. They are, racking up credit card debt. But if you look at their wages, yes, wages are slowing, but they're still rising at a pace that is well above where it was before the pandemic. So people are making more money. Mm-hmm. They're feeling very depressed about inflation, but they're still spending. So, how long this can be sustained, I think that is where we don't have any visibility. We've said repeatedly that the effect of tighter monetary policy is going to filter through the economy. It's just taking some time. And again, people are also locked in on their mortgages at very low rates, and they have, benefited from, refinancing. So they do have, they seem to have this buffer that is supporting a very strong level of, consumption and activity.
Rabila, I agree with you. That disinflationary impulse is fading here in the U.S. I mean, we have core goods inflation at like zero. How much lower can it really get, right? So my question for you is, do you really believe the Fed can achieve a soft landing?
$1 million question. We still think the a soft landing is the most likely outcome. We don't think recession is in the cards right now. We are basing this on a very strong labor market. But we are also, you're talking about this inflationary impulse. Overall, inflation is still decelerating. Yes, core goods inflation is at 0. It was slightly below 0. So we're sort of normalizing on that front. It's the core services. We think that the housing component is going to soften. We also think that this demand for, concerts and, blockbuster movies, maybe, I think that's where the uncertainty lies. We do think that the effects of tighter monetary policy are going to affect households. But, there isn't any imminent risk. We are still watching the labor market. We are still, looking at the continuing claims numbers. If that continues, that'll be a signal that demand side, the demand for labor is easing. And that's going to have an effect on households, on their psychology, and, how much further they're going to go in terms of their spending.
Based on your sanguine view of the U.S. economy, Rubila, do you agree with Janet Yellen that the reason why yields in the U.S., especially on the long end, are higher is simply because of economic momentum and has nothing to do with the deficit?
I think it's a combination of factors. I can't say that it's just the positive momentum in the U.S. economy. We have supply side concerns. There's going to be more spending in the pipeline. There's going to be more issuance. We have, yes, the growth picture, but, and we're looking at demand from other central banks. So I think it's a combination of factors that is really driving yields. And if anything, if it's the supply that is a big factor, I think that's going to drive yields even higher. And if growth is maintained at this, level, which is not our base case, but, that is also going to put upward pressure on yields, long-end yields. And I think that is something that, you can't just isolate it to one thing. I think it's a combination of factors.
The diplomacy there was just fantastic. Rubila Faruqi, thank you so much for being with us. Rubila Faruqi, High Frequency Economics, joining us today. Didn't you heard that, Damien? No. Yeah.
No. Did they cue Taylor Swift, Mr. Perfectly Fine? It sounds like the U.S. economy's doing just fine.
That's what you were hoping to.
I was.
Yeah, I know.
Did I rush it? Did I rush it?
It was
fantastic.
I rushed it. Okay. It wasn't just what we heard from Janet Yellen, because yesterday, Rich Clarida of PIMCO, formerly Fed Vice Chair, was talking with our own Tom Keene, and he basically said there is a good chance the Fed has to go again. They have to hike more. And Menace, to that point, if you believe that there is this strength in the economy, then are rates really as restrictive as they might seem, just on an absolute nominal basis, considering how much they've risen over the past 2 years?
Maybe it is just the long variable lag that everybody historically referred to has changed. It's changed in structure. There is a change in the consumer. There's a change in savings rates. There's a change in helicopter money that was never there before. So we just need to maybe look in a different direction to what a long variable lag is. And by the way, Jamie Dimon doesn't care whether you go 25 bips or maybe even 50. What he is more interested in is shape of the curve. Another 100 basis points on curve. Steepening is perhaps maybe what the Fed hopes for. They're probably just on their knees praying for 5% to hold.
Well, Lisa, I take your point on rate differentials. And if you want to talk about one area on the planet,
emerging markets.
Southeast Asia, actually, right. I mean, they're all low yielders. The Asian low yielders, the Philippines, Malaysia, Taiwan, Singapore, Thailand. Yeah, China, I mean, these rate differentials with the U.S. are getting wider in the wrong direction for them. And how can they compete for offshore funds?
Well, this is a question that I've been asking a lot of people. There's sort of a belief that when the U.S. catches a cold, the emerging markets catch a flu. Are they catching a flu?
They've caught a flu. I mean, look, we're talking about 50% FX declines in places like Nigeria, Angola, Kenya. But you don't hear about it because those economies have very little spillover contagion into the broader developed market complex. And so for me, that's what I'm focused on. Things are breaking, but nobody really knows yet.
Things are breaking, but no one really knows. Like a toxic brew. You're my kind of guy. Coming up, Anurag Rana and Poonam Goyal of Bloomberg Intelligence on Amazon earnings, definitely driving the shares higher, more than 6%. But Menace, you had a good point earlier saying, well, we kind of lost a bunch of steam heading into these earnings. So maybe some of the potential pressure was lifted. Next week, we get Apple from New York. This is Bloomberg.
For the past couple of quarters, there's all kinds of worries about e-commerce slowing. It's getting better. Amazon to us is really in the second or third position behind ESPN for getting the next set of big rights here for sports. The NBA is the next big package for grabs, and there's a good chance that they can get a slate of games.
is Michael Nathanson, MoffettNathanson, Senior Research Analyst, as we parse through the earnings from earlier in the week from the tech space. We're going to get to Amazon in just a moment. I do want to talk about a number of other companies that have been reporting earnings, and that is in the oil patch. There was a time when everyone was talking about how incredible the revenues were that they were driving from higher oil prices. It's a little bit of a different tone this time around. Manaz, we saw actually a miss on both sides. We see actually the shares of Exxon are sort of going nowhere, but after they boosted their dividend payments, Chevron dropping as a result of missing refining issues. What do you make of these earnings?
Well, if you look inside the chemicals business, I think that there's a T-Live on the way, and I think that's probably the biggest number out there, is that the chemical side of the business is dropped by 70%. Maybe that's an indicator of what's going on in the world. You know, we talk about the robustness of the consumer here, strong GDP here in the United States of America, but if your chemicals business is dropping by that much, that sends a red flag to me.
A red flag?
That
really?
is called
no.
stumbling over your words.
No.
I've been here since 2:30.
We all, no, look, I mean, I don't know what we're going to get out of some of these earnings calls with respect to some of the recent mergers, but I think a lot of focus for investors is going to be on that. Like, why? What's the motivation for it? What comes of this? How much is accretive? And I think we need some more clarity on that. So that's the focus.
It's just such a fascinating thing. People think about geopolitical instability, and it will be a direct read through to the oil majors, and it isn't always that clear cut. It is clear cut that when people are spending on clothes, Amazon does well. That seems to be what we experienced yesterday in the earnings. Joining us now to really parse through it, Anurag Rana and Poonam Goyal of Bloomberg Intelligence, covering the tech and the retail side of things. Anurag, I want to start with you. Are we basically just learning that Microsoft is taking the lead when it comes to cloud computing, and Amazon and Google are falling behind?
See, I'm a big fan of what Microsoft's done over the years, but I would not say that they are leading here. I would just say that in the Gen AI, frenzy, they just have a leg up because of their relationship with OpenAI. But Amazon is still the biggest cloud out there. They have more, I would say, revenue than anybody else. That's partially the reason why their relative growth rates are not as strong. But last night's comments on the conference call were so positive, and I think that's what's driving the stock up here. Before that, the stock was flat, and it was just the positive, I would say, body language of the management team that the cloud bottom may be here for them.
Okay, who has the strongest cloud offering, and who will win the most market share?
Well, Amazon's far bigger in terms of revenue. Their revenue run rate is closer to $90 billion compared to Microsoft, which is closer to $60 billion, and with Google somewhere around $24-25 billion. So Amazon's clearly the leader with the biggest network and biggest footprint.
Poonam, let's bring you into the conversation here. This has been a brutal week. At one juncture, we lost $200 billion in market cap of some of these biggest and most loved, most owned stocks in the US. As you go to the close of the week, there was a brutalization of stocks that disappointed on cloud. But the one thing that stood out to me is that there are these tech companies and they are raising prices. How does that play into your thinking?
Yeah, I think on the retail side, Amazon actually has done a great job in maintaining its share and even growing it. When you talk about raising prices due to inflation, I think it's quite the opposite at Amazon. You're actually seeing them push forward low prices, especially on those deal days that they have, like Prime Days. And that's driving the consumer spend. We're expecting Amazon to use its scale and speed to really push the pedal on prices even more as we go through the holiday season. And that's going to drive consumers to their platform, allowing them to gain share over competitors.
Poonam, advertising revenue has been growing at a double-digit clip based on what? 200 million global Prime subscribers. Were you able to get an early read on that Prime Video ads addition?
Video's ad addition is going to take time to build. Right now, the bulk of that advertising revenue is driven from the retail side. And I think that's really key here. That's going to continue to climb. And remember that advertising is a much more profitable business than the retail business and even the cloud business. So as that business scales beyond $50 billion, which it's trending to right now, it's going to drive the bottom line for Amazon. And that addition of the ads that you're talking about, I think that's just icing on the cake. I mean, that's really going to also help build revenues for Amazon and allow customers to choose. Do they want the ads or do they want the content without the ads where they would have to pay a little for that?
Anurag, we've now digested earnings from Alphabet, Meta, Intel, IBM, you name it. What are the primary takeaways from you from third quarter performance?
I think if we are not very close to the bottom, we are probably a quarter or two away, and I think that really sets up well for a big rebound in 2024. And I think that was the biggest fear that we have, that what's going to happen beginning of next year with geopolitical conditions getting worse. And I think last night's results and even Microsoft's comments give us some hope that things are not as bad as people are making out to be.
It does raise a question, though, about the differentiation, Anurag, within the cloud space, within the AI space, and whether companies are being rewarded for investing in some of the AI intelligence, AI programming that could make a lot of money. Did you get the sense that Amazon was rewarded more on that front than Google?
See, one of the biggest thing, I think it's the scale matters now. And you have to remember, most enterprises around the world, Fortune 2000 companies are going to experiment with this technology over the next 12 to 24 months. Who are they going to go to? All these companies have the building blocks for people to experiment. So I'm not saying one's going to win over the other. All three of them are going to get their fair share of revenue from the clients. The problem is on the other side. They actually don't have enough GPU capacity to go out and build some of that AI workloads or training models and other things. But I'm fairly confident that over the next 12 to 24 months, all three of them are going to see some benefit from Gen AI.
Who's got the ability to deliver the best margins? You note that revenue grew by 12% at AWS, but the margin jumped by 30%. Who else is at 30% or beating that? Or is that where the aspiration is to deliver stronger margins? Is that part of the buy thesis?
So one of the things we have talked about, think about all the three companies in the long run. Now, the long run could be 5 years or 10 years. These businesses have potential to grow operating margins north of 40%. Now, that's the reason why we say that is if you look at processing companies and other things, when they reach maturity stage, these are highly scalable business. Once you go through the cycle of capex, you don't really require that much money to maintain them. We are confident in the long run, all three of them will have great margins. The other two companies don't really disclose it at the cloud level, at that infrastructure level, but to that extent, I mean, frankly, Alphabet is still losing money in their cloud portfolio, but there is a lot of different things that go into that.
Poonam, what's the takeaway that we've gotten in terms of these earnings about how much retailers in the U.S. continue their hedonistic tendencies?
Yeah, I think, for the retailers, it's going to be mixed. As we move through holiday, there's going to be clear winners and losers. And we do think that the consumer is really focused on value, and that trend isn't going away for the holiday season. So they're going to have to push the pedal on price, and inventories aren't as high as they were last year. So it's really going to depend on their ability to bring product in to drive demand and really keep prices low this holiday season.
Poonam Goyal, Anurag Rana, both of you, thank you so much for being with us. I can see that you're laughing at me, Damien, for my commentary. Well, that's what.
Well, I read somewhere it's hedonistic.
Oh, be nice.
There's an amazing wine shop in Mayfair called Hedonism Wines. 4-5 floors of indulgent moments with wine.
I love it.
Hedonism.
Well, welcome to
Beautiful.
Fridays. There is a question, though, about how much longer people can actually continue to spend and how much money they have to spend. And what I was struck by, and actually Steve Auth was talking about this earlier, this idea of what we got from Coke shows that they can both raise prices and increase revenues. Is this just tied to the lower sort of tier items?
We should have asked Poonam about Fall Prime Day. I wonder if we got any look through on how that went with Amazon, right? Because that was supposed to be a pretty big, retail sales event. So, I wonder if we got any read through. I have to
tell me when's Fall Prime Day? I got to get into this whole American calendar thing. I know that Thanksgiving is coming up. I'm not here for that.
You'd have to ask my wife because she would be the one.
I have Amazon Prime. I just don't know what benefits I get from it.
You get
NFL. You get the NFL on Sunday mornings.
I keep clicking it at Whole Foods, but there's not much happening.
Coming up, we're going to talk about the spending and the proclivities of many outside of this table. With respect to how that feeds into inflation, we get PCE data at 8:30 a.m. Coming up, we speak with Sarah Hunt of Alpine Saxon Woods. Very curious to hear her take, actually, on the oil majors, considering she's been bullish on this area for a while.
The economy is running out of fuel.
The Fed is not looking to tip the market into a recession. I think that is the bad case outcome in this situation.
There is still more work to be done to ensure that we remain on a disinflationary trend back to 2%.
We've got this sort of European higher for longer theme.
We are still in an environment where the dollar is proving to be the safest haven.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
A quiet beginning to potentially finish a tumultuous week from New York for our audience worldwide. Good morning. Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, Lisa Abramowicz. Tom and John are off today. I am really happy to say I'm with Menace Cranny, who is joining me. And joining us for this hour is Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods. Welcome. It has been quite a week. It's hard to digest everything.
Oh, yes, it has. And I heard you earlier, so I'll just jump in on oil right away and say that, yes, it's not a huge surprise that some of the majors are seeing some issues because you had a big fluctuation in oil prices. But boy, between tech earnings and everything else and the expectation of growth next year, there's a lot to digest in this third quarter.
And we will dig into that later when we talk about Exxon and Chevron earnings and just in general, the geopolitical look right now. Manus, to me, the story was we did get a correction in tech stocks. Is this a buying moment for a lot of people who've been waiting for something like this?
Well, it's a reevaluation. It's trying to sort the wheat from the chaff within the big seven of tech, and how do you differentiate that? Do you just put all your chips down on who's got the best cloud? Do you put your chips down on Netflix raising prices? You know, where and how do you differentiate in a week that wiped nearly 200 billion in market cap? Is it I hate this phrase, buy the dip.
So I think, it's interesting how negative the reaction was to Google versus everybody else. And yes, there was clearly some issues in what is perceived to be their growth business, which is cloud, but the ad business was doing really well.
Yes.
And their commentary around that was not as bad as Facebook's commentary around that, Meta's commentary around that.
Thank you.
So I think that in the scheme of things, I think that there's been some uneven reactions, and it also depends on what's going on in the day. Microsoft had a great reaction, and then it sold off when tech stocks sold off.
There is a comfort talking about actual specific companies rather than just a ping-ponging 10-year yield, and that seems to be the theme for me, at least heading into the end of this week. Even though there was a great deal of volatility, the volatility was constrained within a band for the 10-year yield, and it seemed like it was pinging and ponging between 5% and 4.85%. There is a question about whether that is enough to give people a sense that, yes, this volatility is the new normal, but we're not breaking out to something astronomical. And that seems to be maybe where people are settling out a little bit on the margins.
I would love to believe that that's true. I have some concerns, but I always have some concerns. I think that as we start to look at what's happening with interest rate payments from governments globally, I think people are going to start to get concerned. I think you have a lot of Treasury issuance coming. And the fact that we're doing QT instead of QE, that buyer, as Damian Sassower mentioned earlier, the big buyer in the U.S. is not there. So I think that there's some concern on the supply side. So I would love to see yields just stabilize, but I think that there's some possibility that there might be some more volatility.
So the preface to this next statement is I don't want hate mail about saying that the United States of America might have an existential moment of angst as the Italians had, as the Greeks had. So I'm not saying that, but I am asking the question, if deficits do matter and the cost of funding does matter, what kind of ruction could you have in the bond market 2024?
I think that's the big question. And I think the concern is that without any plan to do something about it, you're going to start to see issuance continue to raise. You're going to start to see concerns about how much the government has to pay on that debt balance. We can't even cut our budget by a couple %. And all of a sudden, interest rate payments are going to start to balloon. And it's going to be a bigger and bigger part of the budget. Okay. And I think that's the problem.
We're going to develop this conversation coming up. Let's take a look at where markets are, trying to create a bit of steadiness, a bit of stability after a week of tumult. We could see S&P futures up 0.4%. The euro kind of going nowhere, although bleeding lower, 105.5. After yesterday's press conference with Christine Lagarde, it seemed like a dovish pause as opposed to Jerome Powell's hawkish pause. At least that's how it was perceived. And the 10-year yield, stasis. I mean, really, it is stasis. And it has been in the morning, every morning. And by the end of the day, it is anything but 4.857%. This idea of how much we have fluctuated is really dramatic. And crude prices right now up about 2% on the heels of geopolitical risk. What we're looking at today, 8:30 a.m., we get September to personal income, personal spending, and core PCE. I am curious to see whether the spending that we have had with respect to consumers has bled into an inflationary pop. It feels like, Sarah, that everyone is believing that we're not necessarily going to get inflation, even though we have strong consumer spending.
I also find that difficult to believe. And I think that you've seen some things come down on some of the big ticket stuff because the pricing power isn't as strong. If you look at things like Tesla cutting, I mean, there's an issue there on the EV side, but also the big ticket stuff might be coming down. But you look at everybody raising prices. Apple just raised their TV prices. Netflix raised prices and kicked a bunch of people off, so they had to become subscribers. I think that there is pricing power.
But we're still buying. We're still drinking Coca-Cola. I didn't notice my Netflix, to be honest with you. Netflix, Coca-Cola. You don't notice some of these smaller and incremental changes in pricing, but at some juncture, does it kick in?
We'll see. I mean, this is going to be some of the questions that we push forward. Today, we also have President Biden meeting with Chinese Foreign Minister Wang Yi when he visits the White House. And Manus, this is going to be really interesting to understand how much of a softening in ties this really is.
Well, I think you made the point earlier, whilst the rest of the geopolitical stage is really at a very, very anxious point, whilst you have a debate about second round inflation, a debate about higher rates, this trade relationship can have an impact in 2024. And that's what's sort of going on in the background. As we hear the sad news that Li Keqiang has passed away. And of course, he was the vanguard of a great deal of understanding what's really going on inside the economy within China.
It comes at a time where a lot of people are saying, including Julian Emmanuel of BTIG, he came out and said, of Evercore ISI, who really was saying this is what's putting a damper on valuations. And it's tough to get too optimistic about the headline level at a time where you do have this sort of fog overhanging things. How much does that sort of give you a sense of pause versus something that you just don't know, so you can't really trade around one way or another?
Well, I think if you look at all of the variables that we have going into 2024, and it's always difficult to predict this early out what's going to happen next year, but I think that a lot of them are pointing towards a slower economic backdrop. The LEIs have been down for months and months and months at a time, leading economic indicators. And I think that you just see some of these things, some of that excess spending that we didn't expect to continue, continued far longer. The tail on that stimulus was a lot longer than I think everyone expected, including us. So I think that now you're starting to see with Coca-Cola, 9% price. At some point, people go, you know what, I'm going to trade down, or I'm going to do less, or I'm going to do something else. I think that does start to change, and that slows things down.
Which goes to 9:30 a.m. We do hear from National Economic Council Director Lael Brainerd speaking about the U.S. recovery at the Peterson Institute. Does she double down on this idea that we heard yesterday, Manus, from Janet Yellen? Basically, the reason why yields are high is because the economy is good, not because of deficits, period, full stop.
Well, look, Yellen has a different job these days, a different title, and a different set of constructive language. It's her job to really defend where the administration is at the moment. And if you think about it, the last three guests that we have spoken to are not convinced that it is not deficits. That is certainly a significant part of the reason why you have a ratchet in yields and a steepening in the long curve. The bottom line is, has the Fed lost control of the long end of the curve? Go figure on a Friday.
Well, Sarah, this is sort of the big question. Do you buy this idea that we've heard from the likes of Janet Yellen and others who are basically arguing it has nothing to do with the deficit? This is all about just simply how strong things are.
I find that difficult to believe. I mean, I'd love to believe that because it would also say that, well, we're strong enough that we can sort of outgrow some of the deficits, and I'm just not sure that we're there. And I think that that's a tack that they have to take right now. But you also look at, some of the ping-ponging in yields is like every time you see something flare up somewhere else, there's a little bit of flight to safety. So was that yields coming down because people were buying bonds for flight to safety, or was that something else? I think it's a difficult thing, but I also think it's tough to say that it's all because the economy is so great.
We were talking to Steve Auth earlier this morning, and he said he's starting to take money out of cash and putting it into risk. He's seeing some of the sell-off as an opportunity. Do you feel similarly? Because it sounds like you're kind of trying to poke holes in a lot of the comforts that people are gleaning in the market right now.
I think the fact that the market has come down certainly helps a lot, because I think where we were, it was difficult to say a couple of months ago that this was a reasonable time to be throwing more money at the stock market. I think it's going to see how this plays out a little bit further, but things have come down, and that does help. Certainly it does help.
It's interesting that in a week that was just so full of volatility, both in bonds and in tech equity. And Lisa, you raised this point earlier. Michael Hartnett's notes out from Bank of America. $2 billion went into tech. That is the biggest addition in 8 weeks. Maybe I'm wrong. That trashy phrase, buy the dip, really is a real thing. It is a real thing, I know. But the most amount of money in 8 weeks went in. do you think you'll see a second swoop of money after the correction come in over the next couple of weeks?
I think you certainly could. And we've been sort of conditioned to buy those dips, right? There's been a 15-year history.
Pavlovian response.
There's been a history of that being a good idea. The question is, what happens if yields stay up here? And are those dips buyable immediately? It's sort of like, do you go out duration now? And the question is, it's not quite clear yet. I think that they're buyable if you have enough dry powder. But I think that trying to lever up or do some of the things that we've been doing over the last couple of years, I think you want to be careful here, because I think that you could have some more of a trading in a range than necessarily disaster.
There is also a question, and I want to finish up where we began, where you came in really excited to talk about oil because you've been hot on the energy stocks. Do you start to fade that at this point, given how much they've flown upward this year and how many potential risks there are, as we saw this morning?
Well, there's an old adage in the oil business that energy stocks are trading sardines and not eating sardines, because they do have a tendency to move around a lot, and you get a lot of volatility. I think longer term, having positions you can trade around is still important. I think we're going to have a longer tail on hydrocarbons. I've said that before. I continue to believe that. But you get a lot of volatility, and geopolitics definitely introduces a lot of volatility. So when you see oil prices go up, if the stocks come up commensurately, there's nothing wrong with taking some of those chips off the table. But I think longer term, it's not something that we want to ignore, which we were trying to do for a little while, on the expectation that hydrocarbons were no longer going to be a part of our economy.
Manus, do you think that oil prices at this point are accurately reflecting the feeling about how much geopolitical risk is rising or falling on any given day?
I think it's very surprising that we are in this tame zone of $90 to $100. I mean, on the week, oil is down, even though it's ratcheted a little bit overnight on the renewed tensions, on the attacks into Syria. You have a tight market. Inventories are lower. The Saudis have taken 2 million barrels. They've cut their production by 2 million barrels. The Russians are there. We can talk about compliance all you want. This is quite a tight market. So I think something unfortunate is going to happen quite dramatically on the geopolitical stage to accelerate you through 100. So unfortunately, it's going to take a great deal of human misery to change the narrative in the oil market, I think.
Well, right now what you can see in oil is you are seeing a bit of a lift, about up 2% after really a down week, one of the first in a while. So this would have been a down week much more. It is pairing those losses. You are seeing yields just marginally higher, but definitely a quiescent feel to end the week, at least for now, although this is how we started out a lot of days, and it's ended anything but. We could see basically up 2 basis points, 4.86%, a little bit of a lift at the front end as well. Euro losing a little steam versus the dollar, and S&P futures up now just 0.3%, pairing some of their gains from earlier. There is a question about the PCE data that we get later today, Sarah, and I am wondering how much you're reading into that to understand just how sticky some of the inflation is and just how much more the Fed's going to have to go. Does this PCE report matter more than others?
I think every single one of them has mattered more than others because they're the ones that are coming in front of us, right? So you want to know what's happening as much as you can see on the ground, even though that backward-looking data. So I think, yes, it absolutely matters. I think the concern about costs coming through is where you're seeing some of the wage hikes, where higher oil prices move into the higher price of goods. There's a lot of issues right now that are somewhat inflationary, that even though some places are coming down, you are seeing other areas, especially in wages and cost inputs, that are coming up. And that makes this whole argument about what's going to happen with the Fed and where inflation goes that much more difficult right now.
We're 12 minutes past 7, and you have given me a very clear impression that you are doubting a lot about what you're being told. You're skeptical of where these markets are. You're cautious going forward. So therefore, the corollary to that is, how concerned are you about a significant uplift in inflation 2024 that perhaps we're all blind to at the moment? We talk a lot about it, but we're hoping it's not going to happen.
I think the possibility is there. It depends if the economy slows enough. If the Fed finally gets what it wants and things slow down, then you might not get as big a jump as you would if we were not slowing down. So I think that we are slowing down. So I think, therefore, that some of that can be, I do think it means that higher for longer could stay. And that could also be an issue.
Sarah, you're going to be sticking with us for the hour. Coming up at 8 a.m., we get Lisa Shallett of Morgan Stanley Wealth Management to understand how to play the dip. Was it enough of a dip? Was it enough of a correction? In New York, you can see a bit of strength to start perhaps a Friday that might be a little bit calmer.
Hurting election season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
Very frankly, his record over his time in the Congress of the United States has been a very hard-edged message that will not create bipartisanship, but we'll see. He said good things, and I hope that he follows through on those. I hope the new speaker follows that trajectory and doesn't serve simply the hard right on his party as his record would reflect. But I want to give him the benefit of the doubt.
That was Representative Steny Hoyer of Maryland speaking on balance of power with Joe Matthew and Anne-Marie Hordern. There is a question of what kind of leader Mike Johnson will be, considering how little people really know about him. Let's get right to it because it's an important conversation, especially at a time where the debt overhang of the United States has played such a big role in markets. Joining us is Isaac Boltansky, Director of Policy Research at BTIG. Can you give us a sense, Isaac, of just what kind of leader Mike Johnson is going to be? Can he find some sort of consensus within a very fractured party?
I think the simple answer to that is no. I think that there are lots of folks who are breathing this deep sigh of relief because now there's someone with a gavel and we can begin handling the people's business again. But when you take a step back, you've got to see that the House Republican caucus is still deeply fractured. It's not clear how well they're going to be able to govern going forward. There's no semblance of bipartisanship anywhere on Capitol Hill. And frankly, Lisa, I think that people are downplaying the risk associated with a prolonged government shutdown. I still think that is distinctly possible because we are nowhere, and I mean this, nowhere when it comes to figuring out a way to fund the government and deal with all the supplemental funding requests that have been sent from the White House.
There's a lot to unpack there, and a lot of people have pushed back against that and said that actually the fact that we have a speaker makes it less likely that we will have a government shutdown. Are you disagreeing with that? Are you saying that basically this is just a window dressing over a pretty big fissure in the Congress?
Look, the unknown right now is how much of a honeymoon the new speaker is going to get. But my sense, when you start to look at some of the specific issues here, and really hone in on things like Ukraine funding. Or you take a step back and you look at the fact that we haven't even agreed on overall spending levels. I think it's incredibly difficult to believe that this group is going to be able to easily avert a shutdown. My base case is that we are going to see a shutdown later this year. I don't think that's going to be a massive market-moving event, but I do think that the getting the gavel to Speaker Johnson has lessened fears in the market, and that's unfounded at this point.
So the president wants a total of $162 billion from Congress across Ukraine, Israel, supplemental spending, etc. How contentious is this going to be? How much of a flashpoint is this going to be? Will it all be co-joined? Will there just be a great dissipation of this request?
So first and foremost, they haven't even agreed on basic funding levels yet, right? So we're not even at a point of agreement over the normal funding levels, and that's going to be the fight for the next few weeks. When we then dig into the supplementals, where you do have over $100 billion in different asks, I think that there is clearly political support for things like funding Israel and supporting Israel and its battle with Hamas. I think that $14 billion is very likely to get done. There's clearly support for more money at the U.S. southern border. I think that that's bipartisan and bicameral. On Ukraine, it's going to be a little bit tougher. And note that this is something that the new speaker has actually fought against in the past. Last night, he did suggest that there is a way to move forward on Ukraine funding, but that there are going to have to be conditions attached to that. No one knows what those conditions are yet. Put it all together, and I think that there is a way forward on this spending package. I just think that we're going to have to go through the same type of pain that we were seeing before when Speaker McCarthy lost the gap.
How long do you think this speaker lasts, or do you think he is there for the duration?
So one of the first things he's going to have to do is try to get rid of that motion to vacate, which pulled Kevin McCarthy out of the chair. I think that the speaker has a decent runway to get into first quarter of next year at a minimum. My conversation suggests that there's a real focus on at least getting to April of next year. As a reminder, that's when the 1% across the board budget cuts will go into effect if Congress does not pass the 12 appropriations bills. So I think that that's the date that a lot of people have circled on their calendar, just trying to make it to that point.
So Isaac, how do you deal with the fact that you are in a situation where the interest that the government has to pay continues to go up? Where does that fall in these budgetary arguments? No one seems to ever talk about it, but it's on the rise. So if we can't cut the budget at all to do what we want to do, how are we dealing with spending that we now are compelled to do?
That's one of the most frustrating parts of the past 3 weeks, is that we weren't talking about the real issues. We weren't talking about the $33 trillion in debt. We weren't talking about the $2 trillion deficit we're running this year. We weren't talking about the $700 billion it costs us just this year to fund our deficits. And so I think that I remain deeply disheartened because we're not having those conversations. And more broadly, no one cares about the deficit when they're in the majority. They only care about the deficit when they're in the minority. And so until we see something that shocks DC to the point where it's forced to think about the debts and deficit differently, it's going to be status quo, business as usual.
How do you force someone to take a look at their own balance sheet and say, your payment next year is going to be double what your payment was this year, and you couldn't afford your payment this year? Why is that not part of the conversation? I know nobody wants to have it when they're in the majority. Nobody wants to not spend because everybody, once they get there, has a million things they want to spend on. But it's sort of like no one is dealing with the elephant in the room, no pun intended, which is the fact that we've got all this spending that still has to come through on this. And I find that particularly frustrating in general. So how do we get to that conversation?
You should run for office. Come on down here and try to figure it out. But look, we're going to have a real fight over this with the Trump tax cuts expiring. You've got trillions of dollars in tax cuts that are coming due in 2025 from the expiration of the Trump tax cuts. And I think that could be a forcing mechanism for a broader conversation. But it's going to depend who's in power. Right. And so the next hurdle is to understand who's ahead in the elections.
How much is Janet Yellen's idea the mainstream, that yields are going to go back down once we get past this blip, and that higher yields in the U.S. is not a reflection of deficits, but really just a reflection of how strong the U.S. economy is? Is that the main idea and belief in Washington, D.C.?
It's the hope of many on Capitol Hill. I don't think that there is anyone who has a firm feel for where yields are going, surely not on Capitol Hill, but it is definitely the hope at this point that everything will fix itself because our politics are so broken, they're unable to fix the problems. And so there's a hope that that's the direction it's going, Lisa, but I don't think anyone has a firm feeling one way or the other.
Hope is not a strategy. I just keep thinking about that. Isaac Boltansky of BTIG, thank you so much for being with us. And Sarah, you did sound very frustrated, and you really reflect the frustration of a lot of people who we speak to in the market. That's to say, we could see this problem careening toward us, and no one's going to fix it.
Well, I mean, this sort of goes to the idea that the solution to debt is more debt. It's like, well, debt doesn't really matter. Eventually, it does start to matter. It doesn't matter when interest rates are zero. It starts to matter when interest rates are not. And if you buy the argument that rates are going to stay higher, that becomes a bigger problem than it would have been had we had the original projection, which is like the rates come up, the rates go down. And therefore, you don't really have to worry about it.
Well, to be fair, I mean, we're having a bash at US debt, but the Italians have upped their deficit funding. The Chinese have upped their deficit funding. Look, I'm not comparing those two economies to the size of your economy, but there is that let's just level on the mountain. And we saw what happened with that before. When rates and a pile of debt collide, it's called the European debt crisis in the early 2011-2013 period.
Well, and this really raises this question of whether the U.S. does enjoy a different type of scenario, because it always has. And you've seen, because all these other economies are doing the same thing, the dollar hasn't weakened that much as a result of this. Because
that's U.S. exceptionalism,
right.
Lisa. Have you not read that?
Yeah, it's in the book somewhere on my table. Coming up next, we'll talk all about that with Ian Lingen of BMO Capital Markets. He was the one who said that treasuries were screaming buy, then sees the technical sell-off continuing, and then now has he changed his tune? That's coming up. hour to key inflation data that could set the tone for next week's Fed decision. Right now, we are looking, welcome back, good morning. This is Bloomberg Surveillance. We are looking at a market trying to claw back after yesterday's significant declines. We are seeing a lift to the market, but the market is fading the more that time goes on. S&P futures up about 0.25%. You could see basic stability in 10-year yields. I keep going back to this, though, Manus. Every single time we say stability in the morning, it has quickly just degraded into anything but.
Yeah, I mean, we're doing this battle royal with 5% on 10-year government bond yields. And for as long as that battle ensues and we prevaricate 5 bips below, 5 bips above, it's going to be much harder for you to decide. But equities are under pressure. The consumer is strong. It's a bit of an anathema. The consumer is strong. The data is strong. The consumer is spending in the United States of America. But you're right, the sort of ramp has rolled over during the past hour. NASDAQ futures are now up 0.7%. We were romping it home a little bit earlier.
And for some people, it was sort of comforting for part of this week. We saw declines in oil prices, which means that there's some sort of at least diffusing of the tensions. That's the market read-through anyway. This morning, unfortunately, we are seeing a bit of a lift, at least when it comes to any geopolitical suggestion, which brings us to under surveillance. This morning, Israel carrying out another limited raid in Gaza. The U.S. military also involved launching strikes on bases in Syria it believes were used by Iran or affiliated groups to attack American troops nearby on Capitol Hill. Newly elected Speaker Mike Johnson saying additional aid to Israel and Ukraine will be taken up as separate measures, unlike the combined $106 billion asked by President Biden. Sarah, aside from just the geopolitics of this, there is a question of how accurately oil can gauge geopolitics, because every morning it seems like that's the sort of litmus test in markets to understand whether we are escalating or de-escalating.
It's an interesting, I mean, it's a measure to use because people are looking for something to see for a signal, right? But there are a lot of other things that go on with that. And I think the harder thing is that right now, because you have that excess capacity at Saudi, there is some thought that if things got much worse, there's at least an outlet. When oil prices surged the last time and went really high, you were both at maximum production and you didn't have a whole lot of storage. Now we have low storage, but we're not really at maximum production. The concern about what's going on with the Middle East is such a difficult thing to play out. Oil is one of the things that people look at. People look at gold. People look at those places where they go, which way are things going? If these things are popping, are things getting worse?
And we'll develop this story a little bit more, but Manus, on the geopolitics side of things, there's a real question about whether Israel is putting off its ground invasion just temporarily, or whether there is a real split on whether or not to do the same kind of, in-ground operation that it previously had been talking about.
Well, there seems to have been a significant shift from language intent. Netanyahu this week was very, very clear that there would be a significant push by the Israelis. But one can say there seems to be a correlation. Macron, Biden, Macron, the Germans, a whole host of European leaders going through, and this pausation.
That seems to be, at least for now. Earnings do continue with oil majors this morning. Exxon missing on earnings per share, but raising its dividend thanks to a surge in cash flow and higher refining margins in the U.S. Chevron missing on a slump in profit due to refining weakness, but boosting next year's dividend and share buybacks. Earlier this week, Chevron announced plans to buy Hess for $53 billion. And Sarah, you were talking about how long-term this is a good play for you. At this point, though, what are you looking at in terms of future tie-ups and the idea of how much there has been already in this space?
Well, from a size perspective, it's not a huge surprise to see companies coming together. The timing of it, I think, coincides with that rise in interest rates because you have some issues with funding certain things that you didn't have a couple of years ago. So all of a sudden, companies that were able to borrow more cheaply, and oil companies have gotten a little bit more disciplined with that, but not a lot. Service prices have gone higher, right? So I want to be a bigger buyer of services so that I can get a better rate for those services. I think it's not a huge surprise. And when it's looked at as an industry that is on the wane, it's also not a surprise to see that M&A activity. The timing of it is always, these discussions may have been going on for a while, and all of a sudden people were like, well, why don't we just do it now? We'll see.
One area that is not on the wane is the tech space, and we've seen Amazon and Intel earnings, both of them giving a boost to equities after the recent sell-off pushed the NASDAQ to its lowest since May. And the S&P on the brink of correction. The NASDAQ is actually in correction, having fallen 10% from its June peak. Amazon posting strong results and saying AI could lead to tens of billions of dollars for its web services. Intel higher this morning after predicting a return to growth in the fourth quarter and an improving personal computing market. Manus, I'm wondering how much these are the same stories and how much they're very different.
I think it depends whether you are putting your hat down for the next round in the Big Seven on the cloud. I just watch and listen to your voice when you talk about the expression about tens of billions or billions in terms of the actual earning potential from AI and Amazon. It's amazing how we're drawn to what is the future. We're drawn to where the next leg in earnings are. And margins. We've just had our Bloomberg analysts on and they talked very clearly about the margins. Margins within AWS are at 30%. The ability is to get that to 40%. So it's a very rich story about the future.
Especially given the fact that Citigroup this morning came out and said that it is granting access to its coders for ChatGPT, which we can get into later, but I thought it was interesting because this is sort of on the margins. ChatGPT suddenly writing reports on Wall Street more.
Oh, do you think it can write a few of the questions for the 3-hour shift on surveillance?
Joining us next, someone who is not ChatGPT, is Ian Lingen, head of U.S. rate strategy at BMO Capital Markets. Ian, nice to see you in the flesh, not as a computer avatar, but I am curious whether you think that this is the new normal in terms of yields bouncing around by 10 or more basis points every day. Are people just going to get comfortable with this?
I think we have seen an increase in realized volatility further out the curve, and that's what makes this so unique in terms of where we are in the monetary policy cycle. What we know is that the Fed is going to remain restrictive for an extended period of time. Chances are that we don't get another quarter-point hike from here, certainly not next week. So 2-year yields are comfortably anchored to around 5%. That means any expression of risk on, risk off, flight to quality, the reversal, all transpires in the longer end of the curve, which means the curve is nothing more than a directional trade, at least for the time being. So I do think that volatility is going to persist until we have a clear inflection in the direction of the real economy, or we simply have another repricing to a higher rates plateau because we have supply on the horizon. And as we saw yesterday, the U.S. consumer continues to drive the economy forward.
Let's just anchor in on the word supply because it's a fascination by all three of us and a greater mind than mine, which is Janet Yellen. She says this spike in yields is not to do with the supply. Of course, that's a political statement, rather than the market's obsession, which is there's no buyer of last resort, there is no QT, the banks have got a problem, and we have got a supply problem. So have we got a serious supply problem to the point of where it re-energizes yields to the upside in 2024?
We're not going to get to 5.50 or 6% in 2024 based on supply. If we do see another extension of the sell-off, it is going to be because there has been a fundamental shift in the way that the market views term premium, the way that the market views the sustainability of higher inflation, and the way that the market views the Fed response. If the Fed revisits or revises its inflation target, that will be the one thing that could bring us to a sustainably higher rates plateau. Now, that doesn't mean that inflation is necessarily going to come down over the course of the next 2 or 3 months, but it does mean that as long as the Fed's framework is in place and the Fed is behaving in a way that gives investors confidence that break-evens will remain contained. Keep in mind, we're at 250, we're not at 350. And so keeping the Fed in play, I think, is the best thing for the longer end of the market.
Well, I mean, I can't imagine what bonds would do on the day that they decide to revisit their 2% inflation target, but I can leave that for other people around the desk. I am interested in term premium because you've either got to arbitrate, as you've got to arbitrate, whether it is rich enough for you to slay a bond vigilante or not. Your answer?
Not yet. But it will get there at some point. I would think that we're going to see the peak in 10-year yields over the course of the next 2 or 3 weeks, and the logic there is very straightforward. Wednesday represents a unique moment in market history. First time that I am comfortable saying that trading the refunding announcement is going to trump trading the Fed decision. Because all that matters at this moment is supply. We get the funding needs information on Monday afternoon, and then that will roll through to whether or not the Treasury is looking at the amount of term premium further out the curve and feeling that that's not quite where they want it to be, and instead favoring utilizing the bill market. We should get some greater context, if not next week, then through communication in the following couple weeks.
So if I think about that statement, then I look at where we've been for the last decade. Why weren't they terming things out when there was no term premium, when you had these very, very low long-term rates? And now you're in a situation where I've got higher rates across the entire curve. I agree that there may be some interesting information from that, but what do we do with that information? Because if they come in heavy on bills, is that saying, no, we're going to wait, and so go ahead and buy the 10-year where it is? Or if they come in 10 years, say, what does that mean? What does that mean for trading?
Mm-hmm. So if we look at what has happened since 2018 in terms of the average maturity of outstanding Treasury debt that's privately held, not what has been bought back, what we see is there was a huge drop in the average maturity following the initial points in the pandemic. And that's because to fund all these programs, Treasury market just dumped a ton of bills into the market. That has since been reversed, as the Fed has to some extent taken advantage, as the Treasury Department has to some extent taken advantage of that lack of term premium. But now, as we see this ongoing increase in average maturities, the Fed is up against this reality of, okay, well, it's going to cost us more conceptually if we want to go out to 10s, 20s, and 30s. So from a practical perspective, we need to figure out as we trade the market whether or not that pendulum has swung too far in terms of term premium. And even if you look at something as simple as the New York Fed's ACH model of term premium, we're in the mid, let's call it 125, 127 range. In the last spike, we got up to 335 basis points. Now, it's important to keep in mind that that was largely front-end led. And with the curve as flat as it is, I think that's what's making this such a important question for the market. Should we stay in twos or should we go out?
Okay, so let's put some numbers on this, because you just said trading the refunding agreement is going to trump anything that the Fed says and the Fed decision this upcoming Wednesday. What is the trigger point in that refunding agreement that could cause true market dysfunction?
Market dysfunction, I think, will be less likely than a clear signal that the Treasury Department is targeting further coupon auction size increases at the February refunding. Everyone expects November to see increases. It's an open question whether or not we actually see them in February. And if the Treasury Department gives us any guidance in that regard, I think that would trigger a more significant sell-off. That's when all of a sudden 505 or 510 in 10-year yield starts to make sense.
Ian Ligon, thank you so much, of BMO Capital Markets. In market, we are about 20 basis points away from that. At this point, we are seeing 10-year Treasury yields hovering around the 4.86%. If you are just joining the program, the S&P steadily losing momentum throughout the morning. Futures up just 0.2% now, 41.63. Coming up at 8 a.m., we get Laura Rehm of FS Investments as we try to understand the PCE, the inflation, the personal consumption expenditure index, that is the key index that the Fed looks at. To me, what Ian just said there was fascinating, Sarah, that basically if the Fed decides to sell a greater number of long duration treasuries in the February meeting, that could trigger a sell-off, unlike what we've seen so far.
There are so many variables that are going on here right now. The other one that I'm thinking about is also Michigan sentiment's coming up later today. We had really bad numbers last time. So I think that there's so much that goes on. So there's that information, there's market information, there's economic information. It is really difficult to parse right now where you want to sit on that curve. And I find it very challenging.
Well, it'll be interesting to see. You got hard data yesterday on GDP. You're going to get a little bit more hard data today on PCE. Versus that Michigan, the soft data, who is in front? Who is in front? Or do you look at the Exxon numbers and go, your chemicals business is down 70%, and that tells you something about the real economy? Just a thought.
It's a confusing brew. That's all I can say. And yesterday, you saw strong GDP. It came out strongest in 2 years, and there was a bid into Treasury. So try to take a signal and then try to get the market right. Go ahead. Coming up next, Chris Marinac of Janney Montgomery Scott on the banking sector. That has been one consistent place of weakness in the regional banking sector. We haven't talked about it that much, but near the lows that we saw during the March crisis.
That next cycle is going to be investment banking led, and it means that in equities, you want to be one or two every quarter as we have been for the last decade. We have a fixed income business we restructured. It's now a top 5 business, and investment banking is going to lead the next cycle.
Ted Pick, Morgan Stanley's incoming CEO, in a conversation with our own Sonali Basak, also with the former CEO sitting alongside him, saying enjoy it because it is a fun and challenging ride. Right now in markets, we could see a bit of a bid to the tape, although really a quiet morning as we reassess the geopolitics, the yield moves, the earnings, a lot going on ahead of some key economic data in the U.S. One aspect of the market that's kind of flown under the radar is the regional banks in particular, especially as we talk about the big banks and the successors and all of that. And we could see that so far, year to date, the KBW index is down 25%. Close to the lows that we saw during the crisis back in March. Joining us now is Chris Marinac, Director of Research at Janney Montgomery Scott. And I know, Chris, that you've been really bullish on the banking sector, and I want to get your take on what you make of the sell-off that has persisted.
Well, I think, Lisa, there's been some continued struggles about the fears of credit quality getting worse in 2024. I think that there's been some passive flows against the banks. I've heard of a lot of folks shorting the KRX and the KRE and then going long the NASDAQ 100. So that has been a challenge in terms of incremental selling. I think to some extent the banks are not sexy here, and they're not doing anything from a growth perspective that causes investors to dive in. And I think most of the fund flows has been to other growth areas and other areas that are kind of avoiding anything that's economically sensitive and perhaps recession prone.
So have you gotten less bullish on this area? Because we have seen a bit of underperformance versus expectations, particularly in the regional space, and there isn't a clear pathway to growth.
Well, the stocks have an opportunity to trade back to 45 to 47 on the KRE. I think the question is, can we get investors to pay attention to what really matters, which is cash flow? The operating cash flow for most banks is only down about 10% from the August estimates pre-third quarter earnings. And so I think the other 90% of PPNR is actually very strong to allow banks to earn through the cycle on credit issues and anything that comes their way. I think their capacity to absorb losses is extremely good. And that's one of the reasons I've thought the stocks have opportunities to do better. I don't think we'll go back to where we would have been on the KRE pre-Silicon Valley, but I do think we can be better than we are. And I think we have to get through this recession discounting that the market is doing at the moment.
Yeah, we are pretty obsessed with the recession discounting. It just hasn't come home to roost yet. Chris, good morning. Provisioning was something that stood out for me as being on the low side in this reporting season. Of course, if there is no dramatic slowdown and there is no hard landing, then that's all justifiable at the accounting reason. Do you think 2024 is going to be marred by an increase, a material increase in provisioning? And if so, where does it hurt the most?
So I think that the provisions will rise in 24, primarily because I think charge-offs will go up. We have a lot of companies who are writing off 15 to 20 basis points of charge-offs, which is very, very low. So going back to 30 or 40 basis points for most mid-sized banks is normal. I think your large national companies probably write off between 45 and 50. So that's a little higher than the 40 range that they are today. So that will cause provisioning to rise. I think generally most banks are going to set aside reserves to kind of build confidence with themselves. Clearly, the accounting on CECL has led banks to actually limit their reserve growth this quarter, less than I would have thought. I think to some extent it is driven by a limited balance sheet growth, and also the Moody's forecast that a lot of banks use has actually pushed out the recession, and that has also tamped down the reserve calculations.
I mean, I think the consensus is obviously JP Morgan just keeps getting bigger. It's just like this juggernaut that just swallows everything and moves everything out of its way. You've listened to the conference calls. You've listened to a couple of these CEOs. Who's under most pressure in the banking sphere? I know I have my target list, but who do you think is under the most pressure as a CEO at the moment?
Well, I think there are regional banks who have capital ratios that are depressed when you take the mark to market for all securities, both for the available for sale and held to maturity. So that issue has to be resolved. I think to some extent banks will work out of their issues on their own because securities are going to start maturing in 24 and 25. And, to some extent, these marks start to flatten out. We don't have to see Fed policy change for the marks to get better. I simply think that some of the payoffs of securities coming due at maturity will help. I think the pressure is on the regional banks who are going to have these new Fed accounting rules, which basically means capital ratios are lower than they're reported. And even though it's phased in over a 3-year period, the market just perceives that they have to adopt those capital rules today. So to some extent, I think we have to fight through that. The good news is the banks are profitable. They can pay dividends. There's no changes happening on some of those major items like common and preferred dividends. So I think the attitude for the investors should be better than it is. But I think the pressure is really on the regional banks where the definition is changing on capital. I do think we'll work through it, but that continues to be the pressure point at the moment.
So does that mean that we have to extend the BTFP, and do you believe that they will extend that?
Well, we don't have to extend it. It would be nice to extend because it simply takes one issue off the table. The use of BTFP has been very limited. It's hovering around 109 billion for weeks and weeks, and so the banks who have used it have used it. Some may renew if given the opportunity, but if they don't, I don't think it's a big problem. It would be nice to do that. It would be nice to have some FDIC deposit insurance reform to be able to buy insurance on uninsured depositors. I'm not sure the FDIC is going to go there. So that would be my thought on that.
So it sounds like the regional banks have a maturity profile that's not as dire as I think some of us were worried about. But I think about some of the assets that are sitting there. Are the regional banks kind of stuck like utilities where I'm in a flat yield curve, so I don't have a lot going on there? I have some things I may have to write off, but I just don't see a lot of growth ahead of me, and they don't have the diversification as some of the money center banks?
Well, I actually think the diversification is actually very good. I mean, you have office real estate's very limited, even commercial real estate's very limited. Within the C&I space, there's a lot of different mid-size and small businesses that regional banks and even community banks do and provide a great service for that. The economy is healthier than I think folks realize, but even if it changes, the ability for companies to earn through is very good. What we see happening is actually less balance sheet growth, but more turnover of old loans that are at low yields, renewing at high yields. A new loan today is going on the books at 8%. And that actually is very attractive, and it's going to cause the mix to shift on net interest margin. We think margins may actually bottom in the first quarter, if not sooner, and that will help the stocks, I think, catch a little bit of a bid.
Chris, just real quick here, final word on Ted Pick, the idea of some of the succession at Morgan Stanley. Is it significant in terms of the direction of that bank, or do you think that it's basically going to be a continuing of the guard?
Well, the investment banking business is the highest margin business of these large international firms, so it didn't surprise me at all that he was the choice. I think that his leadership inside the company has been very well thought of for a long time, so it seemed to make sense. I think to some extent they want to put their best foot forward. Not to be negative on the wealth management space, because it's certainly a huge driver. They've picked up a lot of new customers from the First Republic failure in April and May. So there's a lot happening there, but it seemed to be kind of continuing to push on the investment banking engine.
Chris Marinac of Janney Montgomery Scott, thank you so much. And Sarah, I'm curious from your vantage point whether what you heard from him there made you feel more optimistic about regional banks.
Actually, it did. I would say that there is a perception, especially if you don't follow only banks, that there's, big banks are good and small banks are in trouble. So to the extent that there is more to that regional banking story, and clearly it's also going to be much more diverse because there are different kind of banks all over the country. But the fact that there is less trouble for them if the BTFP is not renewed, I think that is something that is, I would say, good news collectively. And it did make that group look a little bit more interesting.
I think for a moment there was a glint in your eye that we could maybe tempt you into buy. I mean, I've had some fund managers and equity managers wouldn't touch banks with a barge pole. But after that conversation, you look at big banks, small banks. I mean, where or what level of exposure do you want?
Well, we do have some exposure in financials. There's very good dividend yields in financials as well. And to the extent that you want to look at some of the regional ones now that do have those good dividends, but also the balance sheets that are less problematic, because there are companies that spent more time investing in the types of real estate that seem more troubled right now. But the issue is, and I don't disagree that those loans will be at higher rates, we still have to reprice assets for people to take out a mortgage. You have to reprice a home at 8% that you were pricing at a 3% mortgage, and that just hasn't happened yet, which is why I think the housing market's still broken.
And it's the whole story of higher rates should be good for banks. It just hasn't been so far because of all the other concerns. Sarah, thank you. Thank you for spending the hour with us. It was a pleasure having you. Sarah Hunt of Alpine Saxon Woods. Wonderful to get your thoughts. And coming up, just a half an hour, Manus, till we get those key PCE data. Drum roll. Yeah, I think it could be the make or break for the next leg in the Treasury market, whether you retest on the upside. But all the estimates are for incrementally lower. The trend is in place.
the Fed will be happy.
I'm just curious if Ian is right, then it really is going to be the
It's a big call
refunding
by him, by the
agreement
way.
and not necessarily anything having to do with the Fed. Coming up next, Lisa Shallett of Morgan Stanley Wealth Management from New York. This is Bloomberg.
Some things are going to break.
Everyone is looking for reasons to sell everything.
The 5% yield and the geopolitical situation that we're confronting right now is compressing valuations.
We do have a lot of international factors that are impacting the market's expectations.
I think we are going to see further instability playing out over the course of the next few weeks, well into 2024.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's been a week. We're almost there. From New York City, good morning. Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, Lisa Abramowicz. Tom and John both off today. Manus Cranny very much in, which is a wonderful thing. And we are so pleased to say Laura Rehm, Chief U.S. Economist at FS Investments, is joining us for the hour. Welcome. Thank you for being here.
It's going to be great.
Well, it's been a week, and we're all trying to parse through some of the rubble that we've experienced. And part of the issue has been what's going on in the tech names. We were talking about the correction in the NASDAQ, and now we're seeing a bit maybe of a buy the dip moment. And Manus, since I know that you love that comment. I'm just going to,
It's coming to life. It's a reality. It's a gruesome reality. Is that at one juncture, $200 billion, I think that was the headline yesterday, $200 billion was wiped off tech, down 10%. There was a reappraisal, PEs changed. And you're almost sort of forced into a situation of where when something was, 10, 15% higher, 3-4 weeks ago, you must reevaluate and you must ask yourself a fundamental question. If I want to be long and I want to exposure, why wouldn't you buy the dip? By the way, Amazon is just going bing, 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 down. That's sound effects for dying.
Thank you. I appreciate that. Well, that definitely has been the tone throughout the morning, is sort of a losing of steam as the day's gone on.
And I think this speaks to the broader question. Are these moves short-term, or are we kind of trying to find some new normal? I mean, does even in the face of this correction, forward PE is still in the top quintile of expensive. So when you think about re-engaging these stocks at these levels, forward returns historically have not been good, not like in the next year, but 2 years, 3 years out. It's a high place for market entry.
And as a bigger point, I'm glad that you said that, because there's this instability, a feeling that underpinning this market, there's a lack of an understanding of what the paradigm is. We're all waiting for the PCE report, which is the personal consumption expenditure report. I will get it out. That gives you a sense of the inflation. We don't know where we're going back to. And that's been underpinning a lot of the volatility, Manus.
Absolutely. And I think the conversation we had with Ian from BMO a little bit earlier on was very, very clear. He talked about where the bond market goes next, which is the ultimate, not the ultimate, but one of the big drivers for tech. Yeah. And where that bond market goes is going to be defined by the Treasury funding that will be announced at the start of next week. Not so much the PCE, not so much perhaps the data or the Fed.
But the PCE may not help. I mean, I think that's one of the things that we saw from the last CPI report. And there have been increasing disconnects between those two reports. But, the disinflationary process may be lumpier than we expect. And I think we saw some of that service prices creep back in. This 8:30 data could be really meaningful.
Which is certainly something people are looking for, including Andrew Hollenhorst over at Citigroup in markets. As Manus was mentioning, you are seeing a doot as the session goes older, to use his technical term. We're seeing S&P futures up about 0.1%, up after they'd been up about, to 0.5% earlier this morning. Yeah. The euro losing a bit of steam against the dollar. Again, it was amazing how boring Christine Lagarde was, and that was a beautiful thing. Exactly what she wanted. It was a triumph, exactly. That was actually exactly what she was looking for. 10-year yields creeping higher as the day goes on, and this has been a theme every day. We start calm, and then we get a little bit less calm as the day goes on.
Yeah, I think actually something that makes me think that this sell-off in the Treasury market has a little bit more room to run is because it has actually felt pretty orderly. We get to some big numbers, we kind of wait, we reconsolidate, and then it keeps going.
It's interesting. You say Treasury, orderly unwind, equity, moderately orderly unwind. That's 10% down, and that's like 40, 50 basis points in the space of 6 days when we came in to work on Monday morning in the Treasuries. That's orderly. So...
Well, I compare this to maybe a year and a half ago when we were seeing swings in the 2-year that were just 20, 30 basis points in a day. That really felt like traders just couldn't get orders done,
Okay.
This feels like
it's all relative. That's the point.
It feels like we're reframing the concept of volatility. Let's reframe where we're coming from, because we did see that correction in the NASDAQ. We are heading into a period where we're going to get the Fed, we're going to get the refinancing agreement, and we're going to get some inflation data. That's the key data the Fed looks at. Joining us now is Lisa Shallett, CIO at Morgan Stanley Wealth Management. And Lisa, I just want to start with, have we sold off enough? Because I know you've been bearish, particularly on tech. Has this been a big enough sell-off for you?
Look, we're not interested in getting in here unless you're a trader. What we, tend to point our clients to is being investors, being long-term investors. And our perspective has been that we're going to continue to trade in this bear market range, which is where we've been for 2 years. I mean, people have to pull out their telescope and look at where we've been. You look at the S&P 500, we were here in the spring of 2021. And so, this is a trader's market right now. We don't think we break out of this range of somewhere around 4,500, really until the middle of next year. And that's when the fog clears on whether or not we're really going to see growth reaccelerate, or we're going to see, probabilities of recession increase. And we've been in the camp that we're going to be in that second scenario where next year economic growth, particularly in the second half, disappoints. I mean, look at the third quarter GDP. We're doing nominal 8%. What kind of a comp year over year is that going to be in the second half next year?
It's a great point. You said that this is a trader's market when it comes to equities. Is it also a trader's market when it comes to bonds? You've been bullish on longer-term bonds at a time where there's a feeling that maybe this sell-off has legs and actually is fundamentally driven, including by how much the U.S. has to finance.
Yeah, I mean, look, our perspective is that we are probably within 50 basis points of a peak in rates, and that having clients begin to embrace this market, lock in some of these coupons with the potential for rates on a cyclical basis to reset, creates a double-digit return with a third of the volatility. So again, as investors, we think that the buy and hold on some of these bonds is a good value proposition. But I think here too, there's a lot of volatility, and that means you've got to be a trader if you're going to be, in this market looking for returns on the month or on the quarter.
Lisa, good morning. It's Manus. I think that's one of the most honest interpretations. You're not prepared to step and buy into this market in a trading market that we've heard in quite a while. But there is the other side, which is you either view that you've got to build some kind of defense. And I'm drawn to your view that you want real assets and you want gold. Gold is nearly at $2,000 an ounce. So are you actively adding more real assets then if you're not convinced on pure equity?
We are adding and encouraging folks to add some real assets here. I mean, one of our themes has been that, the equity markets in particular are just not pricing real risk premiums. And, one of the things that has, has been heartening to us is the fact not only are we getting higher real rates in the bond market, but that there's a term premium that suddenly people realize that in a new inflation and in a new interest rate regime where the Fed is going to be data dependent, there is lumpiness and there is uncertainty over time about how that data is going to come out. Add in all the geopolitical dimensions to what's going on right now, the dimensions of dysfunction in Washington, D.C., the fact we're rolling into an election year in the U.S. where I think that the headlines and the developments are going to be extraordinarily volatile. Our view is that real assets, things like commodities, things like real estates, things like energy infrastructure assets, could really, be a source of protection here and stability in portfolios.
We just had Ian Lingen here from BMO. He talked about a number of different things that could drive the bond market, term premium being one, fiscal deficits being another. He thinks that the peak the peak spike in rates could be over the next couple of weeks. Would you agree with that? And if so, what part of the bond market would you like to take a portion off or add to? If you're adding real commodities, what would you add in duration?
Yeah, we're looking at our perspective is that the best value right now is really intermediate, somewhere between 4, 6. We're finding some value in 7s in the Treasury market, in fact. But we're looking at investment grade corporates. So we're taking the Treasury yield and taking some of that spread. We do believe that there are quality balance sheets out there that can service these coupons. So we're enthusiastic that the middle of the curve could produce double-digit returns over the next 12 to 18 months.
Lisa, I'm curious about this really different reaction when it's come to these devastating geopolitical events. Normally, we would see U.S. yields plunge in the face of this, and we had that reaction, but you blinked and you missed it. We're right back up again. Does that represent a more fundamental reassessment of treasuries as a risk-free asset? You were going into this government shutdown again, an episode which historically has given us lower yields, and we sort of shrug it off. Is this time going to be different because people are fundamentally reassessing the dollar as a flight to quality? And and treasuries as a flight to quality.
Yeah, I love that you're bringing up this issue. This is one of the issues that we talk about with our clients all the time, because it is our sense that something fundamental is going on and that the appetite for U.S. Treasury debt is different this time. Clearly, the market is readjusting to not having the Fed as a price insensitive buyer, right? We know that, and QT is certainly a weight here. But you look at what's going on among Japanese investors. They're facing the realities of a tough currency compare and really tough hedging costs in terms of their ability to buy treasuries in the size that they have been buying really over the last decade. The geopolitical dimensions of this, historically, we know China has been a big buyer, given their, trade balances and foreign currency reserves in U.S. dollars. There's a lot of complexity and a lot, I believe, to question about why we haven't seen that flight to safety manifest as it historically has in U.S. Treasuries. I do think that this is something we need to watch and study and really think hard about whether or not something is changing and whether the U.S. Treasury market is vulnerable to geopolitics for the first time, maybe since World War II.
Lisa Shallett, Morgan Stanley Wealth Management, thank you. A fascinating point. If you are just joining the program, the S&P is up, but just marginally here, up about 0.25%. Honestly, it's a great question, because what we're looking at right now is this potential that maybe treasuries are not havens the way that they have been traditionally.
Yeah, and I think you juxtapose that against the higher term premium, the stronger dollar. We're getting this shadow tightening kind of coming from everywhere outside of what people are expecting the Fed to do, and it's really just a wet blanket over the broader market. And we keep seeing that. We're positive going into the opening, and then we just kind of end where we end.
But why would you take significant risk? This is the other thing. Why would you take such significant risk on your book 2 months, not even we're almost just 2 months before the end of the year? I think that also plays into it as well. It doesn't pay to be brave, materially brave here in the dying couple of months.
The fact
Maybe it does.
that it's considered risk to take treasuries on your books tells you where we are.
Well, it's year 3 of the great drop.
Right, and I think that is the fundamental insecurity, angst about people who previously viewed this as the haven asset. Yeah. Coming up, we have Bloomberg's Anne-Marie Hordern on the geopolitics sphere.
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
harsh is the way Hamas is using people as human shields. What's harsh is taking a couple of hundred hostages and leaving families anxious, waiting and worrying to figure out where their loved ones are. What's harsh is dropping in on a music festival and slaughtering a bunch of young people just trying to enjoy an afternoon. We know that there are thousands waiting to leave Gaza writ large, and Hamas is preventing them from doing it. That is what is harsh.
That was John Kirby, U.S. National Security Council spokesman. He is also going to speak later today in terms of some sort of press briefing on the latest state of play in the Middle East and also the U.S.'s role there. Welcome back. This is Bloomberg Surveillance. John and Tom are off today, but they will be back next week. I am alongside Manus Cranny, and I'm so glad to say that I'm also alongside Laura Raim. I do want to get to the geopolitics of things because we are expecting a meeting with Xi Jinping's main ambassador today with President Biden. And I want to get right to it because there's a lot to unpack here. Joining us now, Anne Marie Herdern, Bloomberg Washington correspondent in New York City. So glad to see you in New York City. So can we take this as a signal of some sort of softening of the ties between U.S. and China?
Well, the fact that Biden is also going to meet him, this was not on the schedule. He's coming here to meet with Antony Blinken and Jake Sullivan. This is obviously looks like a roadmap for a Biden-Xi sit-down on the sidelines of APEC next month in November in San Francisco. But the fact that Biden is going to show up, shake his hand, say hi to him, feels like a softening of this relationship. In terms of the dialogue, at least they're speaking. That's how bad this relationship is, that the fact that there is dialogue from counterpart to counterpart says a lot. I'd also note Gavin Newsom, the governor of California, had a red carpet welcome from Xi Jinping in China. Xi Jinping has not sat down with the U.S. governor in 6 or 7 years, let alone in the venue he introduced him in. This is set for dignitaries. So that also said to me, reading the tea leaves, that this is likely that Xi Jinping will actually go to California. Potentially the Chinese also are looking at American politics and think, down the road, this could potentially be someone we need to get to know.
That's what I was going to say, is also basically laying the groundwork for a potential election bid at some point in the very near future, if not in the longer term. There is a question, though, today about whether there'll be some discussion about China's position within the Middle East and how they're influencing things, and really to try to support the U.S. in its effort to de-escalate this whole conflict and keep Iran out of it.
So the bedrock of this tension, a lot of it is economics between China and the United States. But then you have these two conflicts in the world right now, Russia, Ukraine, and Israel, Hamas, proxy for Iran. The United States and China are both on the opposite ends of these two conflicts. And that is what scares the foreign policy and the intelligence communities in the United States and around the world. Because what other potential power struggle could there be, say, if something were to happen in the Taiwan Strait? So this is where the concern is. The U.S. and China have taken the complete opposite ends of both these major conflicts, and potentially, at least the fact that they're discussing, China could, in essence, put their thumb on the scale when it comes to Putin, as well when it comes to Iran.
What is it that could shift that dial? Because this is not just China, U.S., this is China, Russia, and Iran, a trifecta, as it were, on that side of the world, versus the United States and the Western alliance. So what could shift? What could shift for China?
I think one thing that potentially the U.S. could try to pressure China, or the Chinese could do, you know this better than I do, Manus, they could say to Putin and to the Iranians, we're going to slow down our buying of your petroleum products.
Or perhaps the U.S. could up its tightening of the screws on Iranian oil exports, where sanctions have been.
True. There are these sanctions on Iranian exports, and the Treasury will tell you, and they continuously tell me,
You can tell me it's working.
Those sanctions have not gone anywhere. The issue is, though, the United States has turned a blind eye to these sanctions. And that is why Iran has been able to make a lot of money in the past few months. And who is the buyer? China. The same way someone quipped to me that Russia has become a penal colony of China as well. All these commodities, China is just buying up, and their support, Xi Jinping, in that sense, is supporting Tehran and Moscow.
The Iranian foreign minister is here in the United States. He's making waves. He's warning the United States, you will not be spared if the Israel-Hamas war spreads. These are aggressive tone and aggressive statements. How serious should these statements be taken?
Well, a lot of it right now is fiery rhetoric. And of course, Hossein Amir Abdollahian has to come out and he has to say this. There's been a lot of backlash, though, on the Biden administration for even giving him a visa, for even allowing him to enter this country. Now, during UNGA week, you do see foes of the United States enter, but this is not UNGA week. And we've seen in the past, the Trump administration didn't allow a visa for Javad Zarif. We've seen in the past, even the Obama administration not allow some visas. So there's even been a lot of criticism towards the Biden administration, the State Department, for why Amir Abdollahian got this visa. But this is fiery rhetoric, and it comes on the heels where overnight there were U.S. strikes on facilities in eastern Syria, where the United States says the IRGC is actually there and operating. The issue we don't know with these strikes is what comes of these strikes. Is it military personnel that the U.S. was targeting? Is it military capabilities? Until we know that, we will understand how much of a deterrence this was.
Looking more domestically and what's happening in the House right now, how is this going to impact these geopolitical conflicts? I think obviously the funding, very soon we are going to be upon a new wave of concern about the shutdown and what that means. And the funding for these foreign conflicts is a huge part of that.
So 2 big issues in the House right now. There's a brand new speaker. He has a little bit of a learning curve, to put it nicely. He has not been part of leadership. And he was at the White House yesterday. So Shalonda Young was there, director of the OMB, obviously talking about the potential government shutdown November 17th. This individual, Mike Johnson, has said he's up for a CR, but with conservative values with it. So potentially some cuts on top of a continuing resolution to keep the government open. Put that aside, there's also these national security concerns. Jake Sullivan was also in that meeting. So he was a sobering reality, I think this individual probably got at the White House in terms of the conflicts that are happening around the world. But he went on Sean Hannity last night, and he said he wants to separate the funding request from the White House when it comes to Israel, when it comes to Ukraine. And he said, what is our end game in Ukraine? So he wants $14 billion for Israel, but where does that leave what is going on with Putin's invasion of Ukraine? That is going to be a little bit harder for this Republican-led House to vote for. The issue is the Republicans have a very slim majority, and that majority might get even slimmer. George Santos is appearing in federal court today on Long Island, and there's an expulsion potentially from him next week by his Republican colleagues, the moderates, who say we need to throw him out. They lose that seat, their majority becomes so much razor thin.
Which is the reason why earlier this morning when we were talking to Isaac Boltanski, he said, basically, this is not a speaker that has any chance of bringing together these different fissures. Yeah, exactly. It's a weak speaker. So there's a question of what actually gets done. Does this make it less likely that we get a shutdown or more? Anne-Marie Hordern, thank you so much. We really appreciate seeing you in New York and not for UNGA week. Whenever you say that, I'm sorry, I laugh because it's UN General Assembly. And I think about that, and UNGA sounds like that song that we were singing every time you come on and talk about this. We are about 5.5 minutes away from this key economic data. Laura, how important is it?
I think it's on the spending side already baked into Q3 GDP data, which we knew was strong. The inflation data is going to be more important. The last CPI reading was less friendly than the market expected. It was not terribly well behaved. And the Fed has made such a spotlight on this little sliver of services inflation. I feel like that might come back to bite them as it kind of has risen again recently.
I like how she makes inflation seem like an unruly child, not quite as well behaved, not as tamed. Basically, the concern about reaccelerating inflation, really key in people's minds right now, Manus.
She's experienced a commercial break where Anne-Marie comes in and somebody else goes out, unruly children on surveillance, but it is about not as unruly as the brief. In terms of the trajectory, lots of people have said, look, the inflation is disinflation is perhaps going to surprise us all. You started the show by that. Will it? Briefly?
I am actually the one person, my off consensus call is that I think inflation is going to be stubbornly high.
Which is, I think, something people are grappling with, which might be part of the reason why yields are where they are. Coming up on the open, we're going to get there in just a minute. Marky Patel of Allspring, Tony Rodriguez of Nuveen, Jay Pulaski of TPW, and Rob Sanderson of Loop Capital.
It's Bloomberg Surveillance. Lisa Abramowicz has absconded. We're waiting for the PCE data. We're joined by Mike McKee around the desk. So we're waiting for the personal spending, the deflator. Mike, will it be disinflationary? Roll of the dice? That's the question. We're waiting for the numbers to come down on the Bloomberg terminal.
Well, got about 4 seconds until that happens. But the idea is we may get a little more disinflation. Let's find out from the Bureau of Economic Analysis. And here come the numbers. And we'll start with the inflation numbers. They come in hotter than anticipated, up 0.4% on a month-over-month basis for the headline. The core comes in up 0.3, which is about what was expected, although there was some leaning towards maybe a little lower number. Year over year now, we see the PCE headline number at 3.4%. That's down from 3.5. And the core comes in at 3.7, down from 3.9. Both of those expected. All the people who like to dive into all those numbers and figure out what actually changed will be with us in a few seconds. Personal income up 0.3. That's lower than the prior month of 0.4 gain, but also lower than what was anticipated, 0.4 gain. Spending up 0.7.
I mean,
no
that's
surprise.
strong on the back of that on the back of that GDP and the consumer.
Well, this number is in the GDP because this is the September number. It was the third month of the quarter, so economists had sort of backed out the numbers and anticipated that this would be fairly strong. We were up 0.4 the prior month. The question is now, do we continue to see that spending happen? Because if incomes are falling behind, and they have been, the spending levels over the last couple of months, that would suggest that maybe there's a pullback ahead. Now, I'm not the expert here. There's one more.
There is indeed. Laura Rain, chief economist, with us this morning. First take?
I think that we continue to see inflation coming down, but it's still unacceptably high from the point of view of the Fed. And I think the conversation as we go into next year the options for the Fed continue to narrow, because if inflation stays about where it is, and it's going to take a long time for it to get closer to 2, their room to maneuver, should the economy slow at all, is going to be very narrow. And look, by these numbers, it looks like the economy is just still incredibly strong. We know that from the GDP numbers that we already got. But, I mean, the spending has just, by the households, has defied every expectation of it to slow. And it's accelerated so much in the third quarter. That's what's extraordinary.
I think
savings rate comes in at 3.4%. People have been watching that for some indication of whether or not they're going to run out of money, the American consumer. That's down from 4%, and it's been a steady decline. But historically, before the pandemic, we used to say people spend what they make. They don't dip into savings the way people tend to think they do. And so if that's the case, then there's more of a case now for maybe a slowdown. People don't have as much to dip into if they wanted to, but they're also not making as much as they were.
Well, I had Janet Henry with me this morning from HSBC, and she said actually Americans are more likely to dip into their savings and spend right till the very end. But I want to bring you an idea from UBS, which is Paul Donovan, where he said, when we go to write the history of the 2020s, do not bet against the hedonism of the U.S. consumer. It's very rich. I love it. I mean, there's a brilliant wine place in London called Hedonism Wines. Whole other story. The hedonism.
You can tell us that later.
I can tell you that later. But I want to understand from you, Lara, the hedonism of the U.S. consumer, is that real? Or do you think that runs out of mileage as well next year?
Listen, he's got a point. That's a really colorful way to put it. But that's what the third quarter felt like, between the headlines about the concerts,
Taylor Swift,
all of the and everyone who followed. I think people seem to be looking for that next experience and looking to pay whatever is required to get it. This issue of savings is gotten so complicated because we, of course, have the excess savings that accumulated during the shutdown.
Yes.
Is that more, bucketed with these, sort of now the highest quartile of households that sort of maybe aren't going to spend them as much. We know that excess savings has run out for a lot of the lower, sort of strata, the other 75% of us who are not in that upper quintile. I think as we think about
the normal people.
Normal people. I think, and yet We just see, and the strong job growth, I think, reinforces the foundation of the household. And we just see this reacceleration is really unexpected.
In terms of your hedonism example here, services spending went up 0.8, whereas goods spending went up 0.7. There was always a story about people switching away from goods, but they still seem to be spending a lot on goods. Services don't go into the retail sales numbers that we got earlier this month, except for bars and drinking places, fitting your theme.
More hedonism.
But 0.8% gain for services, pretty strong. So it looks like people were spending money during the third quarter on all sorts of things.
I do think there's an interesting dynamic here, which is that if you look at consumer confidence, it's still well below where it was before the pandemic. And that's, despite strong growth, strong
So can you tie
jobs,
those two
strong-
together? The consumer confidence being a little bit battered, but the spending, it remains unabated.
To me, I think inflation is something that is still really casting a long shadow over the household. Because, when I'm not here, I'm the mom at the grocery store and I've got one bag of groceries and it still costs me $95 and I can't figure out what's in it, So I think, this idea that year over year inflation is coming down, but the sticker shock is still a very real and present pain point to household budgets.
And Coca-Cola are raising prices, and Netflix are raising prices,
Yeah.
and there are
Apple TV.
and Apple TV, they're raising prices as well. And we are moderately immune to those. Do you know that? You'll still order a Coca-Cola. You'll still order your Netflix movie, Mike.
Well, I was looking here to see if we get Supercore. I haven't got that number pulled out yet, but that's the one that the chairman of the Fed says he likes the most. Let's see if we have that number calculated yet, because you got to take out housing.
And it's the CPI number that had risen the most since, about a year. So I think that's going to be a key piece of today's report too.
Well, just looking at the bond market, it's virtually flat. I mean, 485 is where we are on 10-year government bonds. So there's a sort of a flat, sort of unknown entity within the bond market. Let's just check in on equities, up 0.4%. Again, you've got an Amazon recovery, a nice kicker there. It was up 6% at one juncture, giving a little bit back. You're looking at 10-year yields, just still incrementally rising this morning at 485. We just had BMO in Lingen here with us saying, look, the next 3 weeks will define where the endpoint is for the bond spike in yields. Oil is up 1.93% this morning. Again, there's more geopolitical angst with military action in Syria from the US side, and that has brought, again, a geopolitical bid back to the oil markets. But personal income rises 0.3%. The estimate was for plus 0.4%. So, Mike, the takeaway from this is the core price index rises to 3.7%. Pretty much in line with the estimates.
We're seeing disinflation. I mean, the rate of inflation is slowing down. It's not slowing down as perhaps fast as people would like. And to Lara's point, especially about being the mom at the grocery store, prices go up at a slower rate, but they don't come down. So you're paying more for a lot of staples, and they're going to just stay at that price. And so people look at that, and they're still experiencing inflation, even if inflation is not as bad as it was before.
What happens then to this view in the market that we're going to get rate cuts into 2024? Does that debate change?
It's got to continue. The Fed, I think, now has to just continue to wring rate cut expectations out of that futures curve. I feel like this is the deal with the devil right now, because if you had told me that we were going to have GDP growth of almost 5% and the Fed was not going to cut rates again, I would have just not believed that that was a possible outcome. But Fed futures markets are not pricing in another rate cut. Markets seem very convinced the Fed is done. And I think the only way that works is if we continue to get this drift higher in long-term yields, and there's room for that. Because today, markets have 75 basis points of rate cuts priced in for next year. So if the Fed is going to kind of stay on hold, there's room for that to continue to come out and for long-term rates to continue to move higher.
How do you think they'll look at this in the Fed, Mike? If you look at this, the top line is PCE is at a 4-month high. Consumer spending picks up. it doesn't leave them that huge optionality to be very, very dovish, does it?
They can just sit on this at the moment because they forecast in September, the last time they did forecast, that we would see PCE core at 3.7% at the end of the year. Well,
and we're there.
It's bang on where we are. So most economists think with a couple of months to go, we're going to come in below that. So the Fed could argue its targets are being hit. And you mentioned Ian Ling, and he had a great note this morning about how we're starting to see more impacts from higher Fed rates. And that is slowly getting into the economy, and we should see more. So the Fed is probably going to sit there and say, what we're doing is working. We're at a level where inflation is still coming down. We don't have to go up more right now with all this uncertainty out there about what's going to happen.
Well, and unless inflation is at 9%, there really is no emergency reason to raise rates. That's usually, not a thing. So they, to your point, they have the time. And yet, to me, this increase in long-term interest rates is the reason that they can be patient. And that is going to continue to sort of pump the brakes on activity. When I look ahead at next year, my forecast is for slower growth. I think these higher interest rates have actually increased the chance of a recession, not decreased it.
Is that slower growth no landing, soft landing, not hard landing?
I think it has to be a soft landing. I still feel like there is very real risk of recession next year, and we cannot discount that. But all the reasons why we've been saying it might be a mild recession could also mean that you just end up with some sluggish growth.
So, Mike, as we go towards the close of the year, what's the next piece that you're going to hang your hat on in terms of data? We've got Michigan, University of Michigan this afternoon.
Yeah, I don't think that's going to move the needle a whole lot, but I think what we are going to focus on is all the data next week, particularly the ISM numbers and then jobs at the end of the week. The Fed meets on Wednesday, so they won't have the jobs figures. But at this point, to get an idea of where they're going to go there's less than a 2% chance they do anything on Wednesday, but nobody expects that. But the question is then what happens December, January, and the jobs report will contribute to that. That's what we'll be
checking in. Okay. For our listeners, for our viewers out there, if you're just joining the program, here's a quick check on the markets for you. We have been a little bit higher on these equities this morning. S&P is up 0.25%. S&P avoiding the brutality of a correction that you've had in the NASDAQ. Euro declines by 0.25%. Do you want to be longer of dollar in a haven position? Christine Lagarde managed to do a press conference without any injurious backlash in Europe. Yields tip a little bit higher this morning at 4.86 as the PCE hits the highest level in 4 months. But the core personal consumption expenditure, stripping out food and energy, the volatile components, rises at 0.3%. And we'll keep an eye on that. Crude is up 1.89 as we see a little bit of additional geopolitical risk overnight with targets being hit in some of the proxies. So keep an eye on the oil market, still down for the week, just over 2.5%. We'll give the closing thought to Lara Rain. She's the chief economist with me this morning. At the end of an hour of analysis, a flat, damp squid on the data, really. Your closing thought?
I think this is a week where we're winding down. I think there's been so much news. Today is a day of digestion. As Mike said, we've got a lot coming down the pike next week. Earnings continue. We've got the employment numbers. We've got the ISM numbers. And the Fed meeting, while nothing is expected, I think the press conference always makes us all sort of watch the TV with anticipation and see what was going to happen. I think, at the end of the day, the reason why the Fed has not pushed back on these higher interest rates is because they're probably pretty happy with that move.
Okay, Larry, you stay with me. Mike, thank you very much. That's the first physical outing that we've had with Mike McKee since I've been in America. That was a big moment for me. Mike McKee on the data.
Welcome.
Thank you. Thank you very much. Coming up, we're going to catch up with Marcus Ashworth right here on Bloomberg Surveillance. Good morning from New York.
season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
We're seeing yields go up in most advanced countries. Part of the increase in yields, I think, is simply a reflection of the strength of the economy, the notion that interest rates will be higher for longer. I think it's perfectly possible that we will see longer-term yields come down, but nobody really knows for sure.
Janet Yellen, the U.S. Treasury Secretary, speaking to Bloomberg's Peggy Collins on why these bonds have gone parabolic this week. With me around the desk this morning, we have Marcus Ashworth in the United Kingdom, and we have Lara Rain here, the chief economist. I want to start the conversation with you, Lara, which is listening to Treasury Secretary. Do you agree that it's not because of deficits, it's because the U.S. is so strong? That's why you've had a bear steepening that would knock your eyes out.
You know, I think, of course, it is partly the deficits. These Treasury auction sizes are enormous. They're not going off quite as smoothly as they were when the Fed was engaged in quantitative easing. Now they're tightening. I think that's a piece of it. And then, of course, you know, we just continue to see the data just ripping in a very strong pace. So it's all together. It's hard to really break it apart and tell what's driving what, but the deficits are absolutely a component.
Do you think the attack of the steepeners is done? We just had BMO with us saying the next 3 weeks will define where the peak in rates is, and that comes down to Treasury funding and not the Fed.
I don't think that it's done. And I would even argue that this is not a 3-week event. This is going to be the end of this year into the first quarter. I think there's room for this to continue to move simply because markets are so attached to rate cuts in the coming year. And as long as the data stay as strong as they are, the Fed's going to have to push back against that very hard. We're going to get that on Wednesday.
Okay, let's bring Marcus into the conversation there. Marcus Ashworth is our Bloomberg columnist, and he has watched these markets alongside me for a long, long time. Right, here we go. Next battle on the line is the Fed versus the market. There's a cliche. That has never happened before. So how does the Fed push back at the rate cuts priced into the market next year? Do they need to? Good morning.
Hi. I don't think the Fed's actually that important anymore. I think they're out of the debate, and I think whatever Powell says is not having as much effect, and they ought to be a little bit worried about that. There is a dynamic here of supply very much, I think, driving yields higher. However, I think at the start of this week, we had a look over 5% in the 10-year, and we rejected it. So for now, I'm of the opinion we may have seen a turn in the markets, but maybe only a short to medium-term one. But I think the fact that stocks are down and bond yields are down is important. The only thing I'm slightly worried about is the fact that the dollar keeps on strengthening. But you put those three together, I think we've seen, as we come into Friday, close of a difficult week, where the trends are. And I think that's important to note, is that I think there's been a trend turn, possibly in yields topping out, and more importantly, equities with the earnings season turning down as well. So that's going to be a different dynamic as we come probably into the fourth quarter, where we can start to see obviously a very strong third quarter GDP. Maybe that was again the peak, the last hurrah. At least we got through October without a crash. The seasonals are much better, has to be said, for equities coming up the end of the year. I'm not quite sort of talking Santa rally yet, but the dynamics are there for stocks. But for the moment, I think stocks are looking pretty weak.
Marcus, could there be another interpretation of the fact that Powell's comments recently have not elicited a big market reaction? And that's because he's sort of implicitly blessing this move higher in interest rates. I think if they wanted to really move the market and impact markets, they know how to do that. And the fact that he's choosing language that kind of keeps these trends in place, to me, implies that he may not be all that displeased with this tightening that's happening in the long term with the dollar and also with real interest rates.
I'm going to have to disagree with you there, I'm afraid. I think the fact what he said was so equivocal, to my mind, was the fact that he really was trying to rein in. If this bond yield move at the long end has probably been equivalent to certainly to probably 3 quarter-point rate rises, that the market's doing the work for the Fed. He certainly didn't seem to want to push on that more. I got the impression he was like, enough already, without quite saying that. He can't say that yet, because he does want to get in these rate cut sort of arguments coming into next year, or certainly the back end of next year, he might be comfortable with, but not the forward part. And that, I think, is where the market is going to turn to next. I don't think he wants 10-year yields above 5. That was my impression, but, I'm the born optimist.
Well, I think at the end of the day, the data are going to continue to be a real focus. The really strong employment numbers that we got last month, if that pace of job growth continues, what do you think it would take to swing him back into a more hawkish position?
Well, I think I think that's probably, again, not to say the last hurrah, but we've had some very strong numbers in the back end of quarter 3 into the start of quarter 4. I don't think it's going to last. However, I don't think anyone knows what's going on, so let's not get sort of too clever this. And I think Powell's almost admitting that. He doesn't really quite understand it either. Yellen certainly seems to give that impression as well. Look, it's confusing. The market's, the economy is much stronger than the market had expected. I think a lot of people have thought the economy would turn down by now. You can see what's happening in the yield curve. It's all over the place. It's very confused markets. But yes, if we still get these big numbers on payrolls and clearly on retail spending and consumption and the rest of it, yeah, maybe he does have to go. I really, really don't think they want to. I think the Fed's done. I think the ECB's probably hiked too much. And I think the Bank of England definitely think that they're done as well. So I don't see any rate hikes coming unless, look, if the economy keeps on surprising the way it does, sure, all bets are off.
When you look at that data that we just got this morning, Marcus, core PCE jumps the most in 4 months. I'm surprised there's not a little bit more reaction in the bond market. Do bonds now, given the level of geopolitical angst, and I'm being generous with that word, we have a world at war, we have Ukraine, we have Russia-Ukraine war, we have Hamas-Israel war, we have concerns in the Taiwan Straits. I mean, multiple global threats. Do you think at some juncture bonds do what they were supposed to do and act as a haven, which they have, many say to me, not?
Yeah, I'm glad you mentioned that. The bonds aren't doing. Bonds should be 100 basis points lower in yields if there was any logic left in the world, but clearly there isn't because of the strength of the economy, and yet nasty inflation numbers don't help. Look, geopolitics doesn't matter until all of a sudden it does. So obviously we see anyone else stepping into this nasty situation clearly in Israel and Gaza, then I think the markets will react then. But for the moment, supply is dominating and too much of it, not enough buyers. China's been a big seller. So there are dynamics there. No real buyers, one big seller out there, and clearly the Fed itself isn't helping. The moment that's what the bond market's trying to contend with, and no one therefore is ready yet to step into that safe haven trade. Will it come? It could do. And if it does, it will be quite violently, I think, a sharp drop down in yield. I think we've seen a bit of a turn in yields, but as I said, I'm probably clutching at some thin straws here.
No, it's fine. That's what living in the balmy British autumn weather will give you. I brought it with me here. It's rained every weekend since I arrived. Marcus Ashworth, I leave you to the British autumn. Bloomberg, a columnist. Lara, it's interesting. I mean, that's everything that this market should be doing, and it's just not.
Yeah.
It's just not. I mean, we try to philosophize about it, but I'm going to leave you with a closing thought. The one thing we haven't talked about is the Bank of Japan could pull off YCC, and that could just be the disruptor. Is that a risk that we should have at the tail?
I think this is the time in the cycle when those outlier risks really come in and amplify volatility. That emerging markets, I never discount something in currencies happening. This is the part of the business cycle where you start to get really nervous about, multiple sort of fat tail black swan events accumulating.
And the inflation story of 2024 is possibly going to be key as well. If this oil market really does take off, is that a tail risk for you, or is that migrating to the median, to the middle?
To me, inflation in 2024 is going to be one of the most defining trends. And I think that, again, could upset the apple cart of everybody sort of assuming that things are going to go back to normal. The genie's back in the bottle.
What's normal?
Right. We're going to have to figure that out again.
I think that's the whole issue. What is normalization of rates to 5-6%? Lara, thank you so much for being a sport. We got left on our own in the end, and we didn't break anything. Lara Rain of FS Investments, our guest this morning around the surveillance table. Don't worry, things will be back to normal on Monday. You will have Tom, you will have John, you will have Lisa, you will feel comfortable. Coming up on Bloomberg TV, 10:30 a.m., the Exxon chairman and CEO, Darren Woods, joins the team for a conversation on Bloomberg.